Hello everyone. So we meet again. In the previous session, guys, we had to actually cancel the session which was held on Sunday because I was unwell. But we are compensating that session and having an extra session today. So today our class will be 9 a.m. to 1 p.m. Also, tomorrow it will be the same time and day after tomorrow too. In tomorrow's class, we are going to be solving at least 5 to 7 section B questions, which includes your revenue chapter, your tangible non-current assets and intangible non-current assets, and also the chapter of lease that we've covered. So we are going to understand section B questions in depth, after which we are going to solve a one full-fledged mock paper where you might also find section B questions which are other than revenue, lease and tangible non-current assets which we've dealt with. So you're going to understand everything in detail, right? So let us get started with today's class. So we had covered in the previous section revenue halfway through. We had covered the first simple 5 steps and also understanding repurchase agreement, bill and hold agreement, principal versus agent. And technically, we are supposed to start from where the performance obligation is satisfied over a period of time. So, for each performance obligation which is satisfied over time, an entity shall recognize revenue over time by measuring progress towards the complete satisfaction of the performance obligation. Maybe say you're constructing a building on behalf of a customer. So the customer is going to pay you for constructing this 1, 2, 3, 4, 5. This 5-floor building is going to be constructed by you on behalf of the customer. The customer will pay you for construction of this building. Now this is a construction of a building and it is not like it will be completed within a period of 1 year, right? It might take 2, 3 years. It might take 5 to 7 years also. So for the construction of this building, we are going to recognize revenue over a period of time. Maybe say by the first year, I'm able to complete the first floor. So technically, I might say that, 20% of the building has been constructed. So I might say, okay, 20% of my work is done. I've constructed the first floor. So 20% of the work is done. I can recognize 20% of the revenue. But how do you determine that whether it is 20% or 30%? That we are going to determine through the input and output method that you're going to see later. Okay. So there are appropriate methods of measuring progress. As I told you, this is the progress, the completion of my project, right? So how do you determine that? For determining it, there are two methods, which is known as the output method or the input method. In the examination, guys, they will provide to you whether you're supposed to use the output method or the input method, or they will provide necessary information through which you can, calculate that whether you're supposed to use the output method or the input method. So let us firstly understand what is the formula and what is output method. Output method means nothing but, going at the project and actually certifying the work, looking at the work and certifying it, right? So it is technically the work certified, right? Divide by the total contract price, right? It will be work certified divided by the total contract price. Maybe say I'm constructing a building of 4 floors, right? 1, 2, 3, and 4. Maybe when I actually went to the site and saw first 2 floors are constructed, right? So maybe say the cost incurred for it maybe was around 30,000. And for the completion of the whole project, maybe I'm going to receive 60,000, right? So maybe 30,000 part of the work is completed because for the whole 4-floor building, I'm going to incur 60,000 costs. Okay. Or maybe I'm going to receive 60,000 from the customer. The customer will pay me 60,000 for constructing this 4-floor building, right? And I have completed the first 2 floors. So that means technically halfway through I've completed. So I can say that, this much could be considered as my work certified, right? So it is simply calculated as the work certified. Here, the example that I gave you was 30,000. divide by the total contract price is nothing but the total amount that the customer is going to pay me for the construction of this building, right? So that will be 60,000, correct? So 30,000 into 60,000 into 100% divide by 60,000 into 100%, you will get 50% is your completion, right? Is your progress. 50% is your progress using the output method. Okay. So I hope output method is clear to everyone. Now comes the input method. What is an input method? Input method is nothing but whatever we have within our company. As a construction company, I am constructing a building. So what do I have towards myself? I have the costs that are incurred to date. I might have done certain work over it, right? I might have performed certain activities. I might have done some progress. So for that, obviously, I might have incurred certain costs, like for constructing a building, I might need labor, I might need professionals, I might need material within my company, right? So those are costs incurred to date. Then estimated cost to complete is also necessary. But technically, I'll just show you the formula. It is nothing but cost incurred to date divided by total cost. Now, what is total cost? Technically, if I'm constructing this building of 4 floors, 1, 2, 3, and 4, maybe say I might have constructed the first 2 floors. And for that, I might have incurred $20,000 as my cost, right? So I do know that what is my cost incurred today, and that is $20,000, correct? But today, if I want to recognize revenue, I want to measure the progress using the input method, then the cost incurred to date is 20,000 and it is divided by the total cost. Now, total cost comprises of costs which are incurred to date, that is 20,000, plus the remaining costs. That is the total cost that would incur for the completion of this building. Now, if I am completed till here, I can just take an estimate that what it would require to complete this part of the building, right? I can just take an estimate. So total costs are nothing but costs incurred to date plus estimated cost to complete, right? Total cost will be equal to cost incurred to date plus estimated cost to complete. So simply putting it, total cost will be equal to cost incurred to date plus I don't know how much more cost will be incurred in the future date. So I'm just taking an estimate for the completion of the project, cost to complete the project, right? So maybe say that cost incurred to date, as I said, were $20,000 divide by $20,000 plus I would probably think that I would incur more $25,000. So my total costs are going to be 20 plus 25, that is 45. Maybe you know I'm constructing on the 4th floor or terrace also, because of which 5,000 more I'm incurring, right? So $20,000 divided by $45,000 into 100%. So you will get the progress, right? It will be 20,000 divided by 45,000 to 100. That will be, you can say 44.44% is the completion of the project. So you can actually measure the progress using the input method as well. You just have to keep a note of these two formulae, that is for the input method and for the output method. Okay. This formula and this one. Okay. So I hope the input and the output method is clear to you all. Moving to the next part. What are contract costs? So technically, guys, we are actually incurring the cost for completion of the project, for completion of our performance duties, and those costs that we are incurring, those are recoverable in the future date because obviously the customer is going to pay me for the same, right? So the costs which are related to the contract today can be capitalized under the head contract asset, correct? So they are going to be capitalized under the name contract asset, or you can say contract costs. IFRS 15 says that the following costs must be capitalized. Now, what are the costs which would be capitalized which are related to the contract? Firstly, the incremental cost of obtaining a contract and the cost of fulfilling the contract if they do not fall within the scope of any other standard. Right? For now, you can ignore this part. We'll understand the incremental cost of obtaining a contract. Maybe say, guys, that I have 200 employees working in my company. Okay. I'm a construction company who's into construction business. I construct buildings for and also bridges for people. Now I have 200 employees working in my company right now, but all of them are busy enough within their own work because they already have been designated for some work. Okay. I want to construct a new building. I have got a project to construct a new building. Now, since I have got a project to construct a new building, I will need more employees, right? I will need more employees. I will also need additional material. I will need additional material for the construction of this building. I will hire more laborers for the construction of this building. I will have to hire architects, right? Professionals for construction of the building. It's not like I am constructing the building myself, right? So I will need all these costs to be incurred, and these are directly related to the building. If I would have not constructed the building, these costs would have not incurred, right? If I would have not constructed the building, these additional costs would have not incurred. So these costs are directly related to the construction of the building, and thus they will be considered as my contract costs, right? Now these 200 employees that are working in my company, I am paying salary to them. That salary cannot be considered within contract cost because these 200 employees, I have them with me, right? I have them with me forever. Irrespective of the fact that I construct the building or I don't construct the building, these salaries which are to be paid to these 200 employees that are going to be there, right? So technically, they are not affected by me undertaking the project of construction or not, and is the reason why paying salary to them is not related to the construction of a building, right? So the salary payment to the 200 employees cannot be considered under contract cost. So whatever are the incremental costs of obtaining a contract, that means technically, I am having an incremental cost of purchasing new material for, hiring more labor, for hiring more professionals. So those are related to the contract. Only those will be considered within the contract costs. Okay. So I hope this part was clear to you all. There are many costs which are mentioned within your FR Kaplan book that you can go through, and also I guess the BPP book, where you may see a number of costs which are actually related to the project which can be capitalized as contract costs. The capital costs will then be amortized as the revenue is recognized. So the capitalized costs are technically treated as a contract asset. Right? Why are they treated as an asset? Because today I've incurred these costs, but in the future date, these costs are going to be recoverable. Right? So how will they be recoverable? Whenever I complete the project, maybe say 30% of the project is now completed. So the revenue will be recognized. So it will be amortized to the revenue over a period of time. If in case you're not understanding this point, you can ignore it, and we are going to understand it in detail anyway. Once we do a sum, this will become irrelevant. Okay. Now, how do you actually measure the progress? And according to that, so you've understood how to measure the progress, right? It is either through the input method or the output method. Now, how do you actually identify an expected outcome? Firstly, what is an expected outcome? So maybe say the total contract price. That means the amount that the customer will pay me for the construction or for the project completion is $2 million. Okay, the customer is going to pay me $2 million for the completion of this project. Now, from that, maybe I'm going to obviously incur costs. That so means cost incurred to date I have completed 60% of the project. Okay. Or rather, I should not mention, we'll calculate it together. Maybe say I've incurred 1 million to date. Right. And I'm almost about to complete the project. So the estimated cost to complete, I'll just write cost to complete. You can estimate, you can consider that it is estimated cost only. Estimated additional cost that had to be incurred for the completion of this project is maybe say 2 lakh. So that means in total, the cost that will be incurred, that I'm expecting to be incurred, is 1 million plus 2 lakh, that is 1.2 million. And the total amount that the customer will pay me is 2 million. That means the expected outcome is a profit, correct? Because I'm going to receive 2 million, but the total cost that I'll be incurring is only 1.2 million. That means 0.8 million, or you can say 8 lakh, is my expected outcome, which is a profitable outcome, right? So whenever the expected outcome is a profit, revenue and cost should be recognized according to the progress that we've determined using the input method or the output method, however it is specified in the question. And if the expected outcome is a loss, okay, the whole loss should be recognized immediately, recording a provision as an onerous contract. So technically, if the expected outcome is a loss, if I say that 2 million is the customer going to pay me, that is the total contract price. Costs incurred to date are 1.5 million, and I might incur more 1 million costs, or maybe I'll just say 1.5 million more of the costs are to be incurred, right? So technically, I'm going to incur in total 3 million costs. That is what I'm expecting, right? 1.5 I've already incurred, and I'm saying that 50% of the project is completed only, and I've already incurred 1.5 million. So I'm expecting more 1.5 million to incur. So the total cost that I'm going to incur is 3 million, right? 1.5 plus 1.5. But the customer will pay me only 2 million, correct? So the expected outcome is a loss, correct? These are costs incurred to date, and these are estimated costs to complete, right? So I'm expecting that the outcome is going to be a loss. So whenever I expect that the outcome is going to be a loss, immediately I recognize the loss as a provision. Okay. And what is a onerous contract? Onerous contract, you might have understood it in your provisions also, chapter provision. So onerous contract is a contract wherein I enter into a contract, okay, but the costs that are to be incurred for completing or complying with my performance obligations is going to be greater than the benefits that I'm going to receive from the customer for it. Okay, so that means technically the cost that I might incur, maybe say, is 2 million, and the benefits that I'm going to get is only 1.5 million. So the benefits that I'll receive is not justifiable for the cost that I'm going to incur. So technically, I'm going to make a loss in the future date. So for the loss in the future date, I'm going to recognize a provision today and consider this contract as a onerous contract. Technically, future trading losses can not be capitalized or cannot be stated as a provision, but these are trading losses, but they are unavoidable in nature. They are unavoidable in nature, obviously, because they are as per a contract. So since I've entered into a contract, I have to perform my obligation. So these losses I'm going to incur in the future date, I cannot make a change to it. Now, if the expected outcome or progress is unknown, often due to it being at very early stages of the contract, then the revenue should be recognized to the level of recoverable costs. Okay. So technically, if the expected outcome is unknown, maybe I cannot measure the progress, or I cannot certify the work, right? So I cannot calculate the output method progress percentage. So if I cannot measure the progress, guys, I will not be able to identify, that how much is completed, 20% is completed or 30% is completed. I don't know, right? So I'll just see whether what is the expected outcome. Initially, if I'm at a very early stage of my business, I won't know the progress. but I will not enter into the contract if in case the outcome is not profitable to me, right? So initially I'll always assume that the outcome is profitable. So whatever costs I'm incurring to date, costs incurred to date, those are going to be recoverable in the future date. So those can be actually recognized as my revenue, right? Those can be recognized as my revenue. So my revenue maybe say my costs incurred to date are 30. So revenue will be 30. Then my cost of sales within P&L that will also be 30 and I will make zero profit, right? Technically, I can just recognize the revenue up to the cost incurred to date because they are recoverable in the future date. Okay. Okay. So for actually dealing with full-fledged revenue questions, you have to follow 4 steps. First step is determining the overall expected outcome, whether the expected outcome is a profit or loss. So you'll take the total contract price, whatever the customer is going to pay you, less the costs which are incurred to date, and less the cost that you would require to complete the project. And overall, you will identify whether the expected outcome is profitable or not. Fairly clear. Step 1. Step 2, you have to measure the progress using the input or the output method that we've already understood. I've also shown you the formulae for the same, right? And you can ignore this part, guys. And lastly, step 3, it is you're going to recognize the revenue and the cost of sales within the statement of profit or loss of the company for the year. So it will be whatever is the total contract price. Maybe the customer is going to pay me 2 million for the completion of the project. But I have my progress percentage which is calculated in step 2 here, right? I can recognize 2 million of revenue on the completion of the whole project. But I have not completed the whole project. Maybe I have completed only 50%. And that 50% is calculated using the input or the output method, right? So from this I can only recognize 1 million. Right? Then what is cost of sales? It is the total cost. Maybe my total costs are 1.2 million. And my progress percentage is 50%. So these total costs I would incur on the completion of the whole project. But I have completed only 50% of the project. So I will deduct 1.2 million into 50%, that is 0.6 million. Right? So there is a profit that I will show in the statement of profit or loss of 0.4 million, or you can say 4. Right? That is how I'll recognize my revenue and my cost of sales. Now guys, here they've mentioned something less revenue recognized in the previous years. Here also less cost of sales recognized in the previous years. So technically guys, what they are trying to say here is that maybe say in the first year, the total contract price is 2 million. I'll take the same values and the total cost incurred to date plus the total cost to complete is 1.2 million. Okay. In the first year, maybe I completed 20% of the project. So in the first year, I would have recognized revenue 2 million into 20% and cost of sales 1.2 million into 20%. Correct? I would have recognized that. But when I reach the second year, maybe my completion is 50%. So in the second year, I'll recognize 2 million into 50%, which is 1 million. This is the revenue. And 1.2 million into 50%, that is 0.6 million, which is cost of sales. But guys, this is in the second year I've recognized for 50%. In the first year, I would have already recognized the revenue of 20% and the cost of sales of 20% because I had completed 20% in the previous year. So that I've already recognized. I cannot re-recognize it within the statement of profit or loss, correct? So 20% of 2 million that is going to be removed from the revenue and only the remainder of the revenue will be recognized. So 2 million into 20%, that will be 4.4 million. is going to be removed from the revenue, and only revenue of 0.6 million is to be recognized, obviously, because in the previous year this 0.4 million I've already recognized, correct? So 0.6 million will be recognized this year, revenue, and cost of sales will be 20% of my 1.2 million that I've recognized previously, which is 240, right? So 0.240 million, or I'll just write 2,40,000. From 6 lakh, 2,40,000 has already been recognized. So the remainder 0.360 million, or you can say 3,60,000, that can be recognized as my cost of sales. I hope this is clear to everyone. Okay guys, now we are going to start solving a couple of sums on this, through which you will get exact clarity on how you're supposed to do it. Okay. But before that, we'll just take a 5-minute breather break, so that there is not too much of concept together, and suddenly there's solving. Okay. So we'll just take a 5-minute break. Till then, revise your concept and then we'll solve the question. Okay guys, let us solve a couple of sums. You will understand it there. Also, there is one more step, that is a fourth step that you will understand directly through the sum. Okay. Now, hard floor company fits out nightclubs. The project generally takes a number of months to complete. Right? The project generally takes a number of months to complete. The oops. The company had three contracts in the progress at the year ended 30th April 2017, and the details are as follows. The costs which are incurred to date for J, for K, and for L. There are three different entities given to you, right? Three different projects given to you. There is cost to complete, contract price, work certified, and progress payments which are provided, which we are supposed to understand in detail. Okay, so let us get started. Now, hard floor company accounts for its profits on its construction contracts using the percentage of completion derived from the sales earned as work certified compared to the total sales value. That means technically, guys, we are actually just calculating the total sales value considered by the work certified. So this means this is output method, right? Now, calculate the effects of the above contracts upon the financial statements of hard floor company for the year ended 30th April 2017. Okay. Now, guys, firstly, as per the contract J, we have to identify the first step. So the first step is nothing but work certified to date. Sorry, the contract price is 416. That means we are going to receive 416 minus the cost that have been cost to complete the project is 40, right? And the cost that are incurred to date is 320. So that means 320 we've already incurred to date, and 40 we are going to incur more to complete the project. So technically the project is going to be profitable. You're going to have 416 minus 320 minus 40. That is a profit of 56. Correct? So this is your profit. So the expected outcome is profitable for J. Now we'll check the step 1 for K. For K, guys, the contract price is 684. That means in total I'm going to receive 684. From that, I will subtract the costs which are incurred to date 540 and the cost that will be incurred in the future date to complete the project 90. That will make it 630. So 684 minus 630, 54 is the profit here. And obviously since 54 is the profit here, here also we can actually consider that yes, our contract is profitable. So we will measure it using the progress percentage. Lastly, L, you can see here the work certified to date is given as nil. So that means technically we are probably at the very early stage of the project where we cannot determine that how much of the work is certified. Only the costs which are incurred to date can be determined. So wherever the costs are incurred to date can be determined, we will consider that as the revenue recognized because those costs are going to be recoverable in the future. Correct? So total contract price is 300. From that, your cost incurred to date is 220. Sorry, cost incurred to date is 20. And the cost to complete the project is 220 more is going to be incurred. So this project is also profitable. 300 minus 20 minus 220, that is 60. Correct? So this project is also going to be profitable for you. So we have identified using the first step, and I hope it is clear to everyone. Now we jump to step 2. That is measuring the progress. For the measurement of the progress, guys, we have to take the work certified which is considered, right? So work certified will be nothing but 312, which is for project J, divide by the total contract price, that is 416 into 100%. So you will get the value 312 divided by 416 into 100%, that is going to be 75%, right? This is your progress percentage of the project J. For project K, our work certified to date is 456 divided by the total contract price 684 into 100%, right? So 456 divided by 684, that will be 66.67% approximately, right? And for the last one, the work certified is not there. So obviously we cannot determine the progress percentage, right? So technically whatever are the costs incurred to date, that is 20, that will be recognized as our revenue. Now let us understand the third step, that I'll do it on Excel. For J, K and L, it is nothing but the statement of profit or loss that we are preparing. Okay. So we will firstly consider the revenue which is recognized. That will be whatever is the total contract price multiplied by the progress percentage. For J, the total contract price is 416 multiplied by the progress percentage of 75% which we calculated. Correct? $416 into 75%. We'll do K and L separately. This is the revenue that can be recognized to date. Now, from this, the cost of sales will be there. So, whatever is the cost, total cost, that is cost incurred to date, which is 320 plus the estimated cost to complete 40. So, this will be the total cost that we would incur for the completion of the project. That is how much? 320 and 40. So, 320 plus 40, that is technically 360 into 75%. That will be 360 into 75%, 270. So the profit that we have got for the year, is nothing but 42. Correct? Now we jump to the last step, that is step number 4. That is your contract asset or liability. Technically, your statement of financial position. What will be recognized within the statement of financial position. So guys, within the statement of financial position for J, within the statement of financial position, firstly, whatever is the revenue which is recognized today, that is going to be recoverable, correct? 312, right? 312 revenue which is recognized to date, that will be recoverable in the future date, so that I can capitalize as a contract asset. From this, there is any progress payments, that is 250. The payment has already been made by the customer, right? I can recognize this much revenue. That means if I have recognized this much revenue, the customer will pay me that much in the future date. Now, from this, the customer has already paid me some amount. Correct. So that will be removed because that is no more a part of my asset that has already been paid for. Correct. So that will be progress payments of 250. That will give us a total value of 312 minus 250, which is 62. Okay. So I hope this part is clear to you all for J. So this will be the value of your contract asset within the statement of financial position. Right. Now let us do for K. Right. So for K, the step 3 statement of profit or loss. Step 2, we have already identified that the progress percentage is 66.67% and the expected outcome is profitable. Right. So firstly, we will recognize revenue. How much revenue will be recognized? You can see the total contract price is 684. From that, you've completed 66.67% of the project. So it will be 684 into 66.67% of the project. That I'll calculate it to be 456. Right? So technically, 456 is nothing but the revenue that I can recognize. Now from this, cost incurred to date will be, cost of sales will be deducted. So cost of sales are nothing but costs which are incurred to date, which is 540, plus the cost which would be required to complete the project, that is 90, right? So 540 plus 90, which is nothing but 630 into the 66.67 project completion percentage, right? So it will be 630 to 66.67%, which gives us technically 420. So I'll just directly deduct 420. And the revenue that we can the profit that we get for the year is going to be nothing but 36, right? Now in the step 4, we will just take the contract asset, right? We will just take the contract asset or liability, whatever it is. Mostly it is a contract asset. Technically, we are dealing with statement of financial position, right? So how will step 4 be shown? The revenue that has been recognized today, that revenue will be taken because obviously that has been recognized. And if something is paid from it, technically if this much revenue is recognized, we can say that this much project is completed, correct? Because we only recognize revenue once we have performed our obligation, right? So this much revenue can be recognized, but the customer has paid me how much? Only 480. The customer has made a payment of 480. So that means technically guys, here there will be a contract liability, correct? If in case it is 480, the progress payments which are stated here is 480. So technically there will be a contract liability here, but let's not get into the contract liability part. I'll rather just make it 380. Okay. So if the progress payments are 380, then minus 380 that will give us a value of contract asset of 76. If in case the progress payments were 480, that means technically the customer has prepaid me, okay, and I have not done his work yet. So whatever would be the negative amount, because 480 is greater than 456, that would be treated as a contract liability, correct? But I am not getting into the details of it. It is very straightforward, right? So my contract asset here, as per the second example, is going to be 76. Now as per the last example guys, my step 3, that is statement of profit or loss. The total contract price is 300, correct? So technically I would have done 300 into the progress percentage, but guys, here our progress percentage is only unknown. So how will we recognize, correct? So the revenue that can be recognized is simply going to be the costs which are incurred today. Because see, our expected outcome is that the project is profitable. That means eventually we are going to make a profit, correct? So right now, whatever cost we are incurring, those are recoverable in the future date. So whatever cost we've incurred to date, that much work we've done, so that much we can recognize as revenue, right? So it will be the cost incurred to date, which is 20. So 20 will be my revenue, and cost of sales is nothing but the cost incurred to date minus 20. So you will get the total value to be 0, right? So I'm just recognizing the recoverable cost as my revenue. Lastly, in the step 4, that is statement of financial position, the revenue that is recognized to date is 20, right? From here I've taken directly, and the progress payments till date are made, that is none, right? So the progress payments are none. If in case the customer would have paid me for it, I would have not considered it. So the contract asset is going to be 20 minus 0, which is 20, correct? This is my contract asset. And technically, if you go to see through theory also, I have incurred costs of 20 and the customer has not paid me, but he is going to pay me in the future date. So it will be recoverable. So that will be my contract asset. Okay. So I hope this part was clear to all of you. Right guys. with this, we come to an end of our chapter called revenue. You can get into the more details of it by solving more and more sums wherein you have a number of concepts and a number of new things to it. And we can actually, you can actually ask me directly on the YouTube comment section also. If in case you have any doubts, I'll directly clarify the doubt to you there and then. Okay. Now we're going to intend to start with a new chapter, that is chapter number 3 that we intend to start with. Just make it chapter number 3, shall we? Right? That is tangible non-current assets. Right? Tangible and intangible non-current assets. There are a couple of standards, guys, within this, and it is a big chapter, but obviously it is simple, so we'll actually rush up a little bit with it. By rush up, I don't mean that I'm just going to skip everything. I mean that it'll be so easy that you can actually do it very quickly. Okay. So before starting this chapter, again, we'll take a 10-minute break for everyone to have their breakfast for whom it is a morning, right? So we can actually take a 10-minute break, and after the 10-minute break, we are going to return with a new chapter, that is chapter number 3, tangible and intangible assets. Okay, guys, sorry for being late. Let us get started with a new chapter, that is chapter 3, tangible and intangible non-current assets. Now, what are tangible assets that we already know of, and what is intangible that also we kind of know of? In the layman's term, you can say that something which is tangible is something which you can see and touch, whereas something which is intangible that you cannot see neither touch, right? So tangible assets are actually, for example, any sort of machineries or property, plant and equipment like your land and building or anything, or any office equipments. Whereas intangible assets would be any sort of patents, copyrights, any intellectual properties, or the purchase goodwill and everything. So we're going to understand the accounting of all the tangible and intangible assets. So within the tangible assets, our first accounting standard is IAS 16, property, plant and equipment. So the name of this accounting standard itself suggests that this is related to the tangible non-current assets. Now what is non-current? Something can be classified as non-current where it is actually generating economic benefits for the company for more than a 12-month period. For example, a machinery. This machinery is going to be generating economic benefits for the company for more than a 12-month period. So it can be classified as a property, plant and equipment, right? It can be classified as a non-current and tangible asset. Now, what is exactly property, plant and equipment as per IAS 16? So guys, technically, property, plant and equipment, you can shortly call it as PPE, right? Property, plant and equipment. It is nothing but tangible non-current assets that we are supposed to understand, right? So what is the definition of property, plant and equipment as per IAS 16? Property, plant and equipment is any asset which is used in business, right? Any asset which is used in business, maybe say for administrative purposes. I'll rather write here administrative purposes. Any asset which is used for administrative purposes. Or any asset which is used probably for manufacturing. Any asset which is held for sale. And which is actually generating economic benefits for more than 12 months, right? So any asset which is for used for administrative purposes like office building, or you have a machinery which is used for manufacturing activities, or an asset which is held for sale, which is actually a non-current asset. Probably I want to sell off my machinery, right? So it is not like, today I intend to sell it off and tomorrow it is sold. It might take a couple of months for it to be sold out in the market, right? So that is still classified as a non-current asset, and that asset should be considered as a non-current asset provided it is helping the company to generate economic benefits, or it is being used in the activities of the company for more than a 12-month period. And yes, that you can classify as your tangible non-current assets. So you're going to understand that how these tangible non-current assets are going to be accounted for within the financial statements in accordance with International Accounting Standard 60. Okay. Now, let us understand the recognition criteria of a property, plant and equipment in accordance with IAS 16. So it is probable that future economic benefits associated with the item will flow to the entity. If I've purchased a machinery, considering it, it is an expenditure that I've incurred for the purchase of that machinery. This expenditure, guys, is not a normal ongoing expenditure. This is a one-time expenditure that I've incurred for the purchase of that machinery. And these expenditures that I've incurred, those are going to be recoverable in the future date, because obviously I'm going to make use of that machinery and generate future economic benefits for the company, right? So those are recoverable. So these expenses are recoverable in the future date and is the reason why firstly they are capitalized, right? So the future economic benefits that I'm going to generate from these are actually going to be entitled to me, right? Because it is my machinery, I've purchased it, correct? So it is probable. That means, it is more than 50% chances that I'm going to generate future economic benefits, which will flow to me because I have purchased the asset. It is under my control. And secondly, the cost of the item can be measured reliably. Obviously, the value at which I purchase that machinery that can be determined so that I can recognize it as an asset within my financial statements at a certain amount. Okay, so these two are the important, or you can say the fundamental recognition criteria for the recognition of an asset. Okay, now we understand initial measurement. So guys, we have to initially measure the value of the non-current asset, which is to be stated within our financial statements, like the building that I've purchased, or maybe say the machinery that I've purchased, or any other plant that I've purchased, right? So those are going to be recognized at a certain value. And what is that value? What amounts will be included within that value? That we can determine using the initial measurement conditions, right? So firstly, within the initial measurement, you can see there is a purchase price of an asset, right? So whatever is the purchase cost of an asset, like an asset is sold for 2000, I'm purchasing it for $2,000, right? Including any import duties. If I'm importing the asset, I might incur certain import duties. So those import duties are going to be capitalized to the value of that asset while doing the initial measurement. That means technically, I will recognize purchase price of $2,000. I have incurred import duties of $100. So that will also be added to $2,000 and that will be capitalized. And when I state machinery will not be valued within my financial statements at 2000. It will be valued at 2000 plus this $100 because it is capitalized to the value of the machinery. Okay. Any sort of non-refundable purchase taxes. So for the purchase of that machinery, if I am paying certain taxes, which are actually non-refundable in nature, that means they are incurred for once. Okay. I am not going to get a refund for the same. There would be some say purchase taxes that are refundable probably because I'm making a sale of it later on to someone else. But if they are non-refundable in nature, that means I'm the ultimate consumer who's consuming the asset. So I will have to actually take the tax burden. So guys, here the non-refundable taxes are also to be paid, which are related or which are associated with the purchase of that asset. So those will also be capitalized, right? So maybe say there are certain non-refundable taxes of $20 that have incurred. So that will also be capitalized to the value of the asset. Okay. Then any sort of trade discounts or rebates will be deducted. Correct. Now, if in case I'm making a bulk purchase or maybe, I'm purchasing a very heavy machinery, which is expensive. So usually they also provide us with a discount if I'm purchasing such heavy machineries, right? So when we are purchasing certain heavy machineries, when we get a discount, that amount we've not paid to the to the seller, correct? Because we've got a discount for the same. So that will not be considered within our cost, right? Because that cost is never incurred. It is a discount given to us, correct? So discounts and rebates shall be deducted. Directly attributable costs such as any cost of employee benefits, any cost of site preparation, initial delivery and handling costs, installation and assembly costs, costs of testing whether the asset functions properly. Okay, so technically any cost of employee benefits, maybe say I'm incurring any benefits, I'm incurring any cost for providing any benefits to the employee. Those are directly attributable to the cost of the asset. Cost of site preparation, maybe I am purchasing 10 machineries, but for storing those machineries, maybe I am actually clearing some space, I'm making a proper site preparation. So for that site preparation also I might incur certain costs, and those can also be capitalized to the initial measurement of the asset. Initial delivery and handling costs, maybe I'm actually purchasing the asset, and for the transportation, for the delivery, I might incur certain costs, right? I might have to pay separately transportation and delivery costs. So those will also be capitalized, right? Any sort of installation and assembly costs. I'm installing a computer. So for the installation, I might have to actually pay certain amount. So those installation costs can also be capitalized to the value of the asset. And lastly, cost of testing whether an asset functions properly. So technically, if I am doing certain testing, like maybe, I actually constructed an asset by myself, right? So for the construction, maybe I'm doing certain testing to ensure that the asset functions properly. So then in such a case, those testing costs can also be capitalized to the value of the asset. Then any sort of professional fees that I'm paying, right? So technically, guys, it is not just that I'm purchasing an asset. Even if I'm constructing an asset, the cost of construction can be capitalized to the value of the asset. If I'm constructing an asset, like constructing a building for a customer, then it will be complete different chapter, that is revenue, that we dealt with recently. But if we are constructing for ourselves, we have incurred the cost for the asset that we are going to construct and use. So obviously it will be capitalized to the value of the asset. Maybe I've incurred certain material expenses, I've incurred certain labor expenses, professional fees, everything, right? All those costs are to be capitalized to the value of the asset. When we are constructing the asset, these costs will be incurred. Eventually they will be recoverable once I'm done preparing the asset. Okay. So right here, professional fees are also going to be capitalized. The initial estimate of cost of dismantling and removing the asset and restoring the site on which it is located to its original condition. What happens, guys, usually is that when I'm constructing an asset, once I'm done constructing the asset, or maybe I'll just make it simple. Maybe say, that I have a building. Okay. Okay, I'll make it simple. I have a machinery or maybe a car. Okay. I'm doing an Uber business or an Ola cab business and I'm having a car. I use the car for 10 years. Okay. After those 10 years, I will have to dismantle the whole car because if I just directly go and sell the whole car out in the market, it will not be sold at a very good price. But if I dismantle the whole car and sell its spare parts separately, maybe it's a very good car, it's a Mercedes or something, right? So I sell its spare parts separately. Okay. So if I'm selling the spare parts of that car separately, I'm generating more economic benefits from it, from the sale of that car. Okay. So for the dismantle, I would incur certain costs, correct? For dismantling, I would incur certain costs. So those dismantling costs can also be capitalized to the value of the asset, provided they are unavoidable in nature. Okay. Always remember, guys, dismantling is done at the end of the useful life. That means I use the car for 10 years. After that, in the last year, I'll dismantle, correct? So at that time, I'll incur the cost. So today, I will have to take an estimation of that dismantling cost, right? Because I have to capitalize it today, right? When I purchase the asset. If the asset is of such nature that in the future date, there will be certain unavoidable dismantling costs that I'm going to incur. So maybe say after 10 years of usage of that asset, I'm going to incur 2 million for its dismantle. Okay. I'm going to incur 2 million for its dismantle. So these are costs which are to be incurred in the future date, right? This is a future value. But when I purchase it, that time I'm supposed to include this value. So I cannot just include this future value. I'll have to take the present value of it using the interest rate which is given or the interest rate which is available out in the market. Okay. Then lastly, any sort of borrowing costs. Borrowing costs in accordance with IAS 23, that is borrowing costs. So what they are trying to say here is that if I'm actually constructing an asset. For the construction of that asset, I might have actually taken a loan because I do not have sufficient cash to purchase materials, to hire laborers and everything. So for the construction of an asset, I have taken a loan. The interest payment that I'm making on that loan can be capitalized to the value of the asset under IAS 23 as per IAS 23. Obviously, because I've taken this loan solely for the purpose of construction of that asset, right? And whatever interest I'm paying on that loan, that is an expense to me. But those expenses are going to be recoverable because I'm going to construct the asset and eventually generate future economic benefits, right? So the interest expense, it is related to the construction of the asset and it will be recoverable through the construction of that asset, right? After the construction when I generate economic benefits. So borrowing cost will thus be capitalized to the value of the asset. Borrowing costs are nothing but the loan that I borrowed for which I am paying interest. So that interest is my borrowing cost. You have a separate accounting standard for it, which we are going to understand in detail once we go through the chapter. Okay. Now there are certain costs which are not capitalized. Now what are the kind of costs which are not capitalized? First one is administration and general overheads. What are administration and general overheads? Maybe say I have made a finished product. I have made a complete machinery. Okay. So for the construction of that machinery, after its construction, maybe I'm storing it in a warehouse, right? I've constructed many such machineries and I'm storing it in the warehouse. For that, I am paying warehouse rent, right? So warehouse rent is actually an overhead, okay? Or maybe I'm using the machineries. So where I'm using the machineries, obviously, if the machineries are used, they work on electricity. So I'm paying electricity bill. So these are not directly related costs to my asset and thus they will not be capitalized. These are known as overheads. Any factory rent, any depreciation. Depreciation is also kind of an overhead which is not to be capitalized, right? It will just be expense to P&L every year. Then startup and similar pre-production costs. Okay. So what is startup and similar pre-production costs? Maybe at the startup or maybe, before starting I've incurred certain pre-production costs like testing it or something. So testing mainly capitalizes, but if in case other costs I've incurred, so that will not be capitalized. Training costs, I am actually training my employees to, be better at the course that they are doing, right? So if I'm training my employees, guys, it cannot be capped. For that, I'm incurring costs, right? Maybe I'm teaching them Excel. So I've actually purchased Excel trainings from someone and I am teaching them Excel. So for that, I'm incurring certain training costs. Now, these training costs cannot be capitalized because in actually to capitalize something as an asset, we shall have control over it, right? To capitalize something as an asset, we shall have control over it. Now, we do not have control over our employees. Our employees, if they are moody, if they are if they've had a fight with their spouse, or maybe if they are not well, so they would actually not perform. Even though how much ever training I give them, they will not perform well if they are moody or they would want to leave the company. I cannot have control over my employees. They are human beings, right? They can leave the company if they want to. So I cannot have control over them, and thus the training cost that I've incurred to train my employees, it cannot be capitalized as as a tangible non-current asset. Incidental costs such as wastage. Now this is wastage. Wastage are losses, or you can say any sort of incidental costs that I've incurred. Right? I wasted. I was constructing machinery. In the first time, I could not construct it completely because of certain mistakes. So whatever material costs, whatever labor costs I've incurred on it, those are wasted. So wastage cannot be capitalized to the value of the asset. Repairs and repainting costs, these are actually incurred every year, right? These are actually incurred every year and they do not actually improve my asset. That means if they do not improve my asset, they are not bringing future economic benefits to me. If my asset is damaged, it is just repairing my asset, okay, so that it can be used. They are not increasing increasing or improving or enhancing my asset, correct? So these are not going to be capitalized as a tangible asset. Okay, now let us look at the sum and identify whether which costs are going to be capitalized as an asset and which costs are not going to be capitalized. Okay, an entity started construction of a building for its own use on 1st April 2007 and has incurred the following costs. Firstly, they've incurred the cost for purchasing the land. So purchase price will definitely be included. Stamp duty they've paid, these are stamp duties paid, they will be included. Legal fees paid, they will be included. Site preparation and clearance we just saw, they will be included. Materials and labor will also be included, but there are separate adjustments for them. So we'll look at those adjustments. Architect's fees are professional fees, they will be included. General overheads like any factory rent or something, they will not be included. Always remember general and your administrative overheads are not to be included. Okay. So only this amount is not included, and there are two adjustments for materials and labor. So let us look at them. The following information is also relevant. Material costs were greater than anticipated. Okay, so I anticipated some amount, but the material costs that I have stated here, these are greater than I anticipated. On investigation, it was found that material costing $10 million has been spoiled, and therefore wasted a further 15 million was incurred on materials as a result of faulty design work. Okay. Firstly, $10 million of materials have been spoiled. So this is incidental cost, right? $15 million has been wasted due to faulty design work, right? So $15 million, this is also incidental cost, and incidental costs are not to be capitalized. So my total value of materials is 1 lakh, total cost of materials is 1 lakh, but obviously this is greater than anticipated. That means in this, the wastage and the faulty design work, both incidental costs are included, but that is not to be capitalized. So 25 million, that is 10 million plus 15 million, will be removed from this, so that only 75 million of materials will be capitalized, or you can say 75,000, since it is mentioned as in thousand. Only 75,000 worth of materials will be capitalized, not 1 lakh. Okay. Then labor is of 1,50,000, but let us look at the adjustment. As a result of these problems, that is the faulty design work and the spoiled work, on the building was seized for a fortnight during October 2017, and it is estimated that approximately 9 million of the labor costs relate to this period. Now, labor costs maybe I'm paying on a monthly basis, and the work had ceased for a fortnight, that is for 14 days during the month October 2017, right? So it is within the financial year because we have to prepare from 1st April, correct? So 1st April to 31st March, and it is between that. So October is between that, correct? So between the accounting year, the work actually ceased, right? The work ceased for a fortnight, but obviously since it is my responsibility to pay them, I will have to pay them this $9 million, correct? So it is an expense to me, right? So technically this expense is also a wastage, right? Because they are not working, but I am paying them for it, correct? So this $9 million will also be removed from my labor. So my labor is 1,50,000, from that 9,000, or you can say 9 million will be removed, and thus only 141 will be capitalized. Right? Only 141 will be capitalized. So we'll just do the totaling here, guys. I don't know if this is clearly visible. 235,000 plus 5,000 plus 10,000 plus 18,000 plus we'll only add 75,000, not 1 lakh. Plus we'll only add 141,000, not 1,50,000. Plus 25,000, we will not add 30,000. So the total that we will get after all this will be nothing but 2,35,000 plus 5,000 plus 10,000 plus 18,000 plus 75,000 plus 1,41,000 plus 25,000, which is 5,09,000. Right? So I hope this sum is clear to you all, and I hope you all have understood which items are to be capitalized to the value of the asset and which items are not to be capitalized. Okay? Okay. Now we have understood the initial measurement. Okay. Now we head on to the subsequent measurement of our asset. For subsequent measurement of our asset, we are going to understand depreciation. What is depreciation, guys? Once I purchase the asset, maybe say I've purchased the asset and the purchase price is 1 lakh. Right, $1 lakh. So I will capitalize this as an asset. Right? Maybe I'm going to use this asset for a period of 5 years. So after a period of 5 years, this asset is going to be used only for 5 years. After that, it would have to be sold. It cannot be used for more than 5 years, maybe. Okay. Like if I purchase a machinery, it may be used for 5 to 10 years, not more than that. Right? Or maybe say some machineries which are heavy machineries, they might be used for 20 years, not more than that. Right? So $1 lakh is the value of the machinery. And after 5 years, I cannot use the machinery. So from $1 lakh, I will have to make it nil dollars, or you can say whatever its residual value is that I'll explain you later. You have to make it nil dollars, correct? From $1 lakh, you'll have to make it nil dollars over the period of 5 years. Because obviously after 5 years, I will not be able to use my machinery. Today, my machinery is capitalized within my financial statements at a value $1 lakh, but I'll have to bring it to $0 after a period of 5 years. So what I'll do is I'll charge depreciation $1 lakh divided by 5 years of its useful life. 20,000 I will charge depreciation every year. Okay. Depreciation is nothing but a systematic allocation of the depreciable amount of an asset over its useful life. So its useful life is 5 years, and we've systematically allocated by dividing by 5 years $20,000 as a depreciation every year. Right? Depreciation is going to be charged as an expense. So I will charge it as depreciation expense account debit to asset value going down by that amount. So asset is credited, that means asset value is going down. It will be 20,000, which is the value, right? So technically at the first year end, I have charged depreciation of 20,000 as an expense within my P&L, and I've reduced the value of the asset in the statement of financial position, correct? So in the statement of profit or loss, I will state depreciation of 20,000, and in the statement of financial position, I will state my asset carrying value, that is nothing but the original cost of 1 lakh minus the depreciation of 20,000, which is 80,000. Okay, that is how I'll state depreciation. Okay, now what is a depreciable amount? So what happens is, guys, maybe say I have an asset today. Okay, I have this asset today. This asset may be used for a period of 10 years. Okay, its value right now is maybe say $1,50,000. It is going to be used for a period of 10 years. After a period of 10 years, maybe I have an option to sell out this asset, and whatever is the minimal value that I'll get for it is known as residual value, or you can say remaining value, right? Technically, it is known as residual value, right? That means the remaining value by definition. Okay. So I will get certain remaining value because obviously after its useful life, I will sell it at a scrap sale, and maybe I'll receive $2,500 for it. Okay. I received $2,500 for it. So after I use it for 10 years, the assets value should remain to $2,500, correct? So I cannot depreciate this amount because obviously I will receive this amount once I'm done with it, correct? Once I'm done using my asset for a period of 10 years, after that, if I sell it off, I will get $2,500. So this is not going to be depreciated. So depreciable amount is nothing but the total cost of the asset minus the residual value. So in the example that I told you, 1,50,000 was the total cost of the asset, minus eventually it can be sold for $2,500. So the remaining value is going to be my depreciable amount. That is 147,500. That means technically, guys, I cannot depreciate this amount. That is a residual value. Okay. Divide by 10 years of useful life. So I will only charge depreciation on this value. That is $14,750. Right. So that was your depreciable value. Sorry, depreciable amount and what the concept of depreciation. Okay. So I hope it is clear to everyone. Now, guys, IS 16 requires that depreciation should be charged as an expense in the P&L, that I already told you, unless it is actually permitted to be included in the carrying amount of another asset. Maybe say, guys, that I have a machinery which has a value of $10,000 and a useful life of, I'll not take 3 years, I'll simply take 5 years. Okay, I've purchased a machinery which has a value of $10,000 and it can be used for a period of 5 years. So for that, I will charge depreciation for the per year usage of it, for the per year wear and tear of that machinery, and that will be charged as an expense to P&L. But maybe I have purchased this machinery for the construction of a building, right? I have purchased this machinery for the construction of a building. So, if I have purchased this machinery for the construction of a building, I am using this machinery for the construction of the building. So, whatever is the depreciation and the wear and tear of this machinery, I am doing that for the construction of this building. So, technically, this depreciation expense on the machinery should be capitalized to the value of the building because it is related to the building, correct? So in the building, it will be capitalized because it will be recoverable once the building is constructed. That depreciation expense on that machinery will be recoverable from the future economic benefits that I generate from the construction of that building. Correct? So whatever is the depreciation, that is $10,000 divided by 5 years useful life, that is $2,000. Technically, it is charged to my P&L, but in some cases, it may be capitalized to the value of that building. So technically it will be capitalized to the building. So building account will be debited and depreciation expense will not be shown in P&L. It will be shown $2,000 to the building. It will be added. That is in the statement of financial position, right? And two, my machinery will be depreciated. So my machinery value will go down $2,000. That means technically I've removed the depreciation from this and added to this because the machinery is being damaged, is being wear and teared for the construction of the building. So machinery's value will go down and building, it will be capitalized to the value of the building. Okay. You can skip this part. Okay, I'll explain it. So guys, till now what we did was a method of depreciation which is known as straight line basis, taking just the total value of the asset $10,000, taking the useful life of the asset and depreciating $10,000 divided by 5 years, $2,000 per annum, right? That means it is fixed. Every year I'll charge $2,000 of depreciation, correct? On an SLM basis. But there is also another basis which is known as WDV basis, or you can say reducing balance basis. Technically, they call it reducing balance. So I think we shall also call it reducing balance. It is known as reducing balance basis. Now, what do you mean by reducing balance basis? Maybe say I have a machinery which has a value of $10,000 and maybe the depreciation is to be charged 10% on it on a on a reducing balance basis. 10% on a reducing balance basis. Right? Reducing balance basis. Don't read it as Red Bull, okay? It is reducing balance. So it is going to be treated on a reducing balance basis. $10,000 is the value of the asset. Oops. I will charge 10% depreciation. So that will be 10,000 into 10%, which is 1,000 for the first year, right? So by the first year end, the remainder value of the asset is 9,000, correct? From this 9,000, again I'll charge 10%. So here for the second year, the depreciation will be 900 and the remainder value for the second year end will be 8,100, right? So this is the carrying value at the first year and this is the carrying value at the second year. So you can see here guys, the depreciation value is not fixed here. In the previous example, it was $2,000 per annum, which was a fixed value, right? Because it was calculated on the original cost through the same way, right? But here it is calculated on a reducing balance basis. That means whatever is the remainder balance, on that you will calculate 10%. Okay. So there are both these methods which are available, which are only examinable. There are one or two more methods like the machine hour or the sum of the digits method, which is not examinable. So we are not getting into the details of it. Okay. Now, you can ignore this part, guys. It is not that important. Let us solve this sum. An asset costs $1 lakh and has an expected useful life of 10 years. The purchaser intends to use the asset for 6 years, at which point the expected carrying value will be $40,000. What is the depreciable amount? Right? What is the depreciable amount? Now, firstly, an asset has a value of 1 lakh. Correct? An asset has a value of $1 lakh and it has an expected useful life of 10 years. So the depreciation per year will be $1 lakh divided by 10 years, which is $10,000. The purchaser intends to use the asset for a period of only 6 years, and after that, at which point the expected carrying value will be 40,000. Correct? So technically, he wants to sell it at $40,000 after 6 years, right? So you have to identify what is the depreciable amount. So technically, how we will calculate the depreciation? It will be simply taken as $1 lakh is the value of the asset. From that, he is going to sell it at just a second. The purchaser intends to use the asset for 6 years, at which point the expected carrying value will be $40,000, right? So the expected carrying value on that date will be $40,000. After that, he would intend to sell it. So if in case he's selling it at $40,000, so that is my residual value. Correct? It is my residual value. So if in case I'm going to sell off my asset, now this example is too lame, it is irrelevant, but I'm explaining you because you have to understand everything. But technically, even if we skip it, it doesn't make a huge difference. But since we've started it, I'll explain it. Maybe say the asset has a useful life of 10 years, but I want to use it only for 6 years and then sell it off. So 1 lakh is the total value of the asset, and the carrying value that would be there after 6 years would be around 40,000. That means I would sell it at this value maybe after 6 years, right? So this amount will not be depreciated because this I will recover once I sell the asset. Technically, it will be depreciated at 1 lakh minus 40,000, that is 60,000, divided by 10 years. I can charge depreciation of 6,000 every year. Okay, but technically, guys, this question is a bit weird. It is irrelevant. You can skip this, otherwise it will make you confused. Rather, we'll solve one more example, not here. Yes, after this concept. Okay, so that is irrelevant, guys. You can ignore that part because that will make you more confused about what the concept is. So that we can skip as of now. Okay, now we'll just take a break of 5 minutes, and after that we'll return with the remainder of the talk. Okay guys, I hope we are back from the short break. Now let us understand subsequent expenditure. Initial measurement we've understood what is depreciation. Now we are going to jump to subsequent expenditures. Now, in case of subsequent expenditure of property, plant and equipment, they can only be capitalized if it enhances the economic benefits. Maybe say there is a building. Okay. If the building is damaged from here, the building is damaged from here. These are repairs. Repairs cannot be capitalized because it is damaged. It is just making the building back. It is just bringing the building back to the position where it was. Right? But maybe over this building, I'm constructing a terrace separately, which would enhance the quality of the building which would enhance the value of the building out in the market, or from which the building could be used for a couple of more years, right? Maybe I'm strengthening the base or something, right? So here, technically, I'm making an improvement to the building. And because of this improvement, my building is enhanced, or my building would actually be used for a longer period of time. And that is the reason why subsequent expenditures which are considered as improvements are to be capitalized, but subsequent expenditures which are repairs or repaintings, those are not going to be capitalized. Okay. It enhances the economic benefits provided by the asset. This could be extending the asset's useful life or an expansion in increasing the productivity of the asset. Maybe there is a machinery. Okay. There is a machinery which I am enhancing to actually, I've added one part to it, one spare part to it, which enhances the quality of the machinery and which is going to be up to the mark with the technological advancement. So initially my machinery did become too old, right? So it was not as per the market technological advancement. The new machineries out in the market were very advanced, but mine was too old, because of which my machinery could not have been used for a longer period of time. But I added one spare part to it, because of which the machinery again got new. The machinery was as good as a machinery which was available as per the technological advanced market, right? So guys, here it would increase the useful life. That means now I can use the machinery for a longer period of time, correct? So it would actually bring future economic benefits to the company, this improvement, and thus it can be capitalized to the value of the asset. Any overhaul costs? Overhaul costs are nothing but inspection costs for complex assets. It is taken into consideration. What is a complex asset? Like your car or your airplane. Now there is an airplane. The airplane might be used for a period of 35 years to 40 years, right? But airplane has many other assets, right? In the airplane, there is an engine, there are wheels, there are seats, there is air conditioning. If the airplane can be used for a period of 30 years or 40 years, that doesn't mean the other components within the airplane can also be used for the same period of time. There is a possibility that I might have to, replace my air conditioning after a period of 10 years. Correct? So, there is complex assets like airplane, which has many other assets like building. Building has many other assets within it. Like building might be used for 50 years, but the elevator within the building that may not be used for 50-year period, right? So you have to depreciate them on different basis. And for that, you're supposed to inspect that, all the components within the complex asset are okay or not. So to inspect that, everything is okay, you incur certain overhaul costs. Like you do the inspection like once in every 3 years or once in every 5 years, right? So those are also going to be capitalized, those inspection costs. Okay. So I think we can skip this part. That much was relevant for your overhaul costs. Now, under IS 16, guys, there are two models. Under IS 16, for the subsequent valuation of your asset, there are two models that you can adopt. So technically, guys, as per the International Accounting Standard 16, there are two models which are available for the subsequent valuation of an asset, which is permitted by IS 16. First one is known as the cost model, and second one is known as the revaluation model, right? So the cost model does nothing but just the total value of the asset is taken into consideration, the original value, which is maybe say originally I purchased it for $1 lakh. It was to be used for a period of 10 years. So I will just take the depreciation on it and $1 lakh divided by 10 years, that is $10,000 will be the depreciation charged every year. Accordingly, I'll keep on calculating the value of the asset every year using the cost. The second model which is available is known as the revaluation. Now, cost model is not a reliable estimate, to be honest. Is not too much of a reliable estimate because maybe say when I purchased the asset, I thought that I might be able to use it for a period of 10 years, right? So I took the asset value to be $1 lakh divided by 10 years useful life. That is $10,000 of depreciation each year, right? I depreciated like this for a period of 3 years. At the end of the third year, my asset value will be 70,000 because $10,000 I've charged for 3 years. So 1 lakh minus $10,000 charged for a period of 3 years. So 10,000, 10,000, 10,000, 30,000 I've charged in total. So the remainder value, that is the carrying value at the third year end, is 70,000, right? But this is taking the estimate on the date when I purchased. When I purchased it, the market conditions were different. Accordingly, I estimated that the asset would be used for a period of 10 years. But obviously, at the end of the day, it is just an estimate. And for that estimate, the changes are bound to occur, correct? Because at the end of the day, it is an estimate. So guys, here, the estimate and the carrying value that we've taken, that might be different from the actual market value for an asset, right? In the market, if I go and identify, the same asset would probably be worth 80,000, right? Or it might be worth 60,000, right? So it is not showing an up-to-date value of the asset as per the current market conditions, and is the reason why to eliminate this problem or this issue of cost model. The another model is available for the entities to adopt under IAS 16, that is the revaluation model. So you can actually revalue your asset. So what is a revaluation model under IAS 16? Revaluation model under IAS 16 is a hypothetical situation that you're actually selling your asset hypothetically. And if you're selling your asset hypothetically, you're calculating the value of it, right? So if I sell my asset today, it would be sold in the market for $1 lakh. And from that, I'm identifying that, okay, in the market for today, the asset could be sold for $1 lakh. So its fair value is $1 lakh. That is the revaluation model. So hypothetically assuming that my asset would be sold, I'm calculating its fair value in today's date. Okay. So carry an asset at its fair value at the revaluation date less subsequent accumulated depreciation and impairment losses, right? So before going forward, let us do a sum on it. I'll explain you through the sum. Revaluation model. Okay. Maybe say I have an asset, I have a machinery which has a value of $50,000 and a useful life of 10 years. So the depreciation that will be charged is nothing but $50,000, which is the total value of the asset, divided by 10 years useful life, which will give me the depreciation to be 5,000. At the end of the fourth year, what will be the carrying value of my asset? My carrying value of the asset will be 50,000 was the original value minus 5,000 I might have charged for the first year, 5,000 for the second year, 5,000 for the third, and 5,000 for the fourth. So in total, I've charged 20,000 as my depreciation till the end of the fourth year, right? So I'll just directly deduct 20,000. So the carrying value of my asset will thus become 30,000 at the end of the fourth year, right? Now on this date, maybe in the market, the fair value of that asset in the market is actually showing to be 45,000, right? The fair value of the asset out in the market is shown to be $45,000. So technically guys, in the market, if I go and sell out this asset today, its value is $45,000. So why am I carrying it at $30,000? I should increase it to $45,000, correct? Right? So to show an up-to-date value of my assets, correct? So I will actually revalue my asset. I will have an option to revalue my asset under revaluation model, right? And this will be known as revaluation surplus. Why revaluation surplus? Because as I'm revaluing my asset, 45,000 will be the new value after revaluing it, and before that it was 30,000. That means I'll increase my asset value by 15,000, right? I will increase my asset value by 15,000. So this is a gain, or you can say an income that I've generated, right? Of 15,000. So it will be known as revaluation surplus, and it will be stated in the statement of other comprehensive income. Other comprehensive income is a statement which is prepared below your statement of profit or loss. It is shortly known as OCI, and it is prepared for the owner's equity, for storing, for accumulating the owner's equity separately. This revaluation, this is not a gain that I've already earned, right? I've not earned this $15,000. I've not received it because I've not sold the asset. Assuming that I sold the asset, I will calculate its current market value, right? I have not actually sold it. So this I have not received it yet. So this will be stored in the owner's equity, and the journal entry that we will pass for this revaluation is simply going to be asset value is being increased. So asset account will be debited to revaluation surplus account, right? Why am I storing it in my equity, in my OCI, and not within the P&L? Because in P&L, guys, the profits and losses that we get is related to the trading activities of the company, whereas this is not associated with the trading activities or the business activities of the company. This is like once a while they actually revalue it. So this is any revaluation gain which is not realized yet. Okay, because obviously we've not sold the asset yet. So it is stored separately in the owner's equity under the head revaluation surplus, right? So asset account debit, assets value we will increase by 50,000, and that increased value will be stated as an income within the other comprehensive income under the name revaluation surplus, right? This will go to OCI, and my asset value in the statement of financial position will increase by 15,000. Okay. Now, guys, you all might be thinking, okay, that the fair value has increased. There could probably be a revaluation loss also instead, right? There is also a possibility that there could be a revaluation loss, right? So I'll take the same scenario that um, I'll just take the same scenario that I'm adopting the revaluation model. The asset had a value of $50,000 and had a useful life of 10 years, and thus the depreciation that I charge every year is 5,000. Correct? The depreciation that I'm charging every year is 5,000. Correct? The same scenario. At the end of the fourth year, the carrying value of my asset, the carrying value of my asset is 30,000 as we calculated previously. Maybe on this date, I go and check in the market that what is the market value of my asset. So the fair value that I've identified out in the market for the same asset, maybe say is not 30,000, but instead 25,000, right? Ignore the previous example. Okay. This is a new example. So the asset fair value is 25,000. That means it is a revaluation firstly, right? I will revalue it, and it is a revaluation loss to me. Correct? It is a revaluation loss because my asset value is going down. Correct? My asset value is going down. So 30,000 minus 25,000, it is a loss of 5,000. Correct? So it is a revaluation loss of 5,000. So how I will recognize this revaluation loss? Guys, revaluation loss is always taken to P&L and not to other comprehensive income. Correct? Revaluation loss, always remember it is taken to our P&L and not to other comprehensive income. So our journal entry will be nothing but revaluation loss account debit, since it's like a loss or an expense to me. Expenses or losses are debited. And 2, my asset value, since it is going down, I'll credit my asset, right? I'll credit my asset by 5,000, right? So this was the accounting for a revaluation model, where in case there is a revaluation surplus and where in case there is a revaluation loss. Okay, I hope it is clear to you all. Now guys, in this there are also more details. That is, what happens if, just a second. Maybe say I have adopted the revaluation model. I'm taking the same example. There is a machinery of $50,000 with a useful life of 10 years. Thus, depreciation charged per year is $5,000, right? So, the carrying value at the 4th year end is $30,000, and the fair value that I identified out in the market was $45,000. So, taking into consideration that my asset might be sold, I am calculating the current market value of my asset and revaluing it upwards, right? So I will charge the revaluation surplus as an income to my OCA, and I also pass the journal entry for the same. Okay. So it is stored in my other comprehensive income, 15,000, right? Now guys, it is stored in the other comprehensive income, 15,000, on a later date, maybe for the same asset, this machinery. Okay. Maybe for the same machinery, on the later date, maybe say, now firstly we will charge depreciation for the further years to come, correct? We will charge depreciation for the further years to come. So what is the depreciation now? Firstly guys, the new asset value. Okay, I'll explain the subsequent depreciation, and after that I'll explain you the part that I intend to. Firstly, the asset new value is 45,000 because we revalued it upwards, and now its new value has become 45,000, correct? We debited the asset by 15,000, its carrying value was 30. So 30 plus debit of 15,000 more. So 45,000 is the new asset value. What is the remainder of the useful life? Now the remaining useful life is only 6 years, correct? My asset had a useful life of 10 years, out of which I have already charged depreciation of 4 years, correct? I have depreciated my asset for 4 years already. So now I have a new value of the asset and the remaining useful life is 6 years. So the subsequent measurement after the revaluation will be taking into consideration this, that is depreciation 45,000 divided by 6 years, which is the remaining useful life of the asset. So it will be nothing but my depreciation value will now be 7,500, which is to be charged every year. It will obviously increase because suddenly my asset value has increased, right? So that is how I'm going to do the subsequent measure. Okay. Subsequently, you're going to measure it like this. Now maybe say I have an asset, okay, which had a cost of $20,000, right? Which had a cost of $20,000. Now, maybe say the fair value of that same asset in the market was $30,000. So technically, I would state as per the revaluation model, the journal entry that I would pass is nothing but asset account debit to revaluation surplus account. That is, my asset value is increased from 20,000 to 30,000. So I will state it here. Okay. This will go to my OCI. Right. So this journal entry I'll pass. Right. Now later date, maybe the asset got revalued again. Okay. So the new value of the asset is now 30,000. Correct. Because I have increased my asset value by 10,000 and its carrying value was $20,000. So the new value is now $30,000. After this new value, after the revaluation surplus, again my asset got revalued. Okay, in the next year, maybe again my asset got revalued, and for that, maybe I got a revaluation loss. Okay, for that, I got a revaluation loss. Maybe say my carrying value is now 30,000, but the fair value in the market is only 18,000. Correct. The fair value in the market is only 18,000. So that means this is a revaluation loss. So technically the revaluation loss is 30,000 minus 18,000, which is 12,000. As I told you earlier, revaluation loss is directly to be taken to P&L. So revaluation loss account debit to asset value going down by that amount. That is 12,000, 12,000. Right? This is the journal entry that I would usually pass. But that is not to be considered here, because before having a revaluation loss, the same asset was having a revaluation surplus, right? So this revaluation surplus is stored in OCI. Now this cannot happen that the asset has a revaluation surplus, okay, and again the asset has a revaluation loss, and both of them can be shown, correct? The asset might either be at loss or be at profit, correct? It's not like it can be at profit and loss at the same time, correct? So if previously in the previous year maybe the asset had a surplus of $10,000, and in this year it has a loss of $12,000. So first I will have to eliminate this $10,000, right? First I have to eliminate this $10,000. That is because if I have a loss, right, I cannot have a surplus with that. So that means the journal entry that I will pass is simply going to be, just a second. Yes, is simply going to be, first I will remove my revaluation surplus. So revaluation surplus will now be debited to remove the amount of 10,000 from my OCI. I'll remove it. Okay. Then my total loss is 12,000, from which 10,000 is adjusted with the revaluation surplus. Correct? Because I've removed it, because considering I have a revaluation loss. The amount above that, 12,000 is the total loss, out of which 10,000 I have charged to OCI to remove the complete surplus, and the remainder is 2,000. So still my loss is there. That 2,000 loss will be shown here as a revaluation loss account debit of $2,000. So always remember, usually my revaluation loss goes to P&L, but before the revaluation loss, if there is a revaluation surplus, first you should eliminate the revaluation surplus, and then the amount of loss above that will be taken to P&L. So technically from my OCI, 10,000 will be deducted. In my P&L, 2,000 will be charged as a loss, and my asset value will go down by $12,000. So that was all the concept that we need to understand for, that was all the concept that we need to understand for a revaluation. We can skip this because it is not that important. I've shown you the journal entries and also the calculation for the same. Okay. Okay. Okay, let's do derecognition now, guys. Okay. So when my asset is derecognized, what is the journal entry that I pass? Maybe say the carrying value of my asset in my books was to $22,000. I sold it for its fair value, that is $30,000. Right? In the market, I sold it for 30,000. I'm not revaluing it, guys. Don't get confused. I am selling it off. Okay. I sold it for $30,000. That means on the sale of this asset, I got a profit. Right? For the sake of selling it, maybe I've incurred certain costs to sell, that is commission. Maybe whoever helped me sell this asset at $30,000, they charged a commission of maybe say 1,000. Right? They charged a commission of 1,000. Right? So I'll just state it here on my Excel. The carrying value of the asset was 22,000. The fair value of the asset at which it was sold is 30,000, and for selling it, I have been charged with certain commission by the broker or whoever I had hired for selling it of 1000, right? So technically, what is the value that I got? I got the fair value, which is this amount minus the commission that I paid, right? Fair value minus cost of sales, that is nothing but net disposal proceeds, right? Technically, I received 30,000, but for the sale, I paid 1,000 commission. So I received only 29,000 for the sale of that asset, right? So this is the net disposal proceed, that on the sale of that asset, the proceeds that I've received is 29,000, right? Whereas the carrying value is 22,000. So that means my net disposal proceeds is 29,000 that I've calculated, and the carrying value of the asset is 22,000, which will be subtracted to identify that what is the profit on sale of this asset. That is going to be 29 minus 22, which is 7,000. Okay, so 7,000 I have obtained the profit of that asset, and the journal entry that I will pass is nothing but asset is going to be derecognized, correct? Cash account debit. What is the net cash that I've received? 29,000, correct? Because 1,000 I paid as a commission. My asset is derecognized, so my asset will be totally eliminated. It will be on the credit side. Its carrying value was 22,000. It is totally eliminated from my financial statements because I'm derecognizing it, right? I sold it, so I'm derecognizing it. And the remainder will be stated as a profit within the P&L on the sale of my asset, which is going to be 7,000 as we calculate, right? So this will be stated as a profit in the P&L. This will be removed from the statement of financial position, and this is cash account debit anyway, so that we can directly calculate, right? Yes. So disposal of a revalued asset. Now we'll understand disposal of a revalued asset. Now guys, maybe say there was an asset. Actually, we'll directly understand it through an example because we have it here. Let us read through the example and then do the accounting for the same. Derek purchased a property for $750,000 on 1st January 2014, and it had a useful life of 10 years with no residual value. If there was a residual value, maybe say 50,000 was the residual value, so the depreciation would have been 7,50,000 minus 50,000 divided by 10, right? Because obviously the residual value is not to be depreciated, correct? Now guys, at 31st December 2014, that means at the first year end, the property was valued at 8,10,000. It got revalued, right? So because of this, there was a revaluation gain of $1,35,000. You can ignore this as of now because I'll show you the calculation. There was no change to its useful life. Derek does not make a transfer to the realized profits in respect of excess depreciation on revalued assets. On 31st December 2016, the property was sold for 9 lakh dollars, right? You will not understand this part, guys. You can ignore it as of now. Required, how should the disposal on a previously revalued asset be treated in the financial statements for the year ended 31st December 2016, right? So let us understand this example. Firstly, guys, on 1st January 2014, the asset was purchased and the cost of the asset was 7,50,000, right? By the first year end, that is 31st December 2014, the asset got revalued, correct? Firstly, I'll calculate the carrying value. So asset's useful life is 10 years. Right. So 1 year has passed from 1st January 2014 to 31st December 7,50,000 into 1 year divided by 10 years of useful life. So the depreciation that we are going to charge is 75,000. So the carrying value will be nothing but 7,50,000 minus 70,000. I'll just take the carrying value here. The carrying value at the first year end will be nothing but 7,50,000 minus 75, that is 6,75,000. Right? This is the carrying value of the asset at 31st December 2014. Right? Just a second. Why is this happening? Yes. So the carrying value at the first year end, we have identified it to be 6,75,000. But as you can see, they have clearly mentioned that on this date, guys, the asset got revalued to $8,10,000. Correct? On this date, the asset got revalued to $8,10,000. So the asset's carrying value was 6,75,000, but on 31st December 2014, the revalued amount was 8,10,000. Right? That means my assets carrying value was 6,75,000, but it got revalued to 8,10,000. So the remainder is a revaluation surplus. Correct? Because its value increased. Correct? So 8,10,000 minus 6,75,000, 1,35,000 that they've mentioned. I told you can ignore it. We'll calculate it. Correct? So $1,35,000 is the revaluation surplus. The journal entry for the same that will be passed is nothing but asset account will be debit because we are increasing the value of the asset, and we will state revaluation surplus as an income within our other comprehensive income. And the value of it will be nothing but 1,35,000, 1,35,000. This will go to your OCI. This will be added to your asset value in the statement of financial position. Right? So at 31st December 2014, now the asset has a new value after its revaluation. That is, it was 6,75,000 plus we added to the value 1,35,000 after the revaluation. So 8,10,000. That means technically this new value. Correct? So the new asset value is 8,10,000. What they are saying further is that here they are saying that on 31st December 2016, that means 2 years later, the property was sold for $9 lakh, right? The property was sold for $9 lakh. That means technically after 2 years, what would have been the carrying value? Firstly, we'll calculate that. Okay. Now the asset's new value is $8,10,000 and I have charged depreciation of 1 year. Correct? Its useful life in total was 10 years. I have charged depreciation of 1 year. So the remaining useful life is 9 years. Right? The remaining useful life of the asset is 9 years. So for calculating it till 31st December 2016, I will have to charge depreciation for 2 years. Correct? Because from 2014 to 2016. So depreciation will be 8,10,000 into 2 years divided by 9 years useful life. Correct? So 8,10,000 into 2 years divided by 9 years useful life. So the depreciation charge of 2 years will thus be 1,80,000 and the assets carrying value at the year 31st December 2016 will be 6,30,000. But it is sold for how much? It is sold for 9 lakh. Correct? So if it is sold for 9 lakh, we got a profit on its sale. That is 9 lakh minus its carrying value 6,30,000, which is 2,70,000. The journal entry that we will pass is cash account debit because we sold the asset, right? So we received the cash for it. 2, asset will be derecognized from the financial statements because I sold it. So it is no more my asset. I do not have control over it, right? So it is sold for 9 lakh. I received 9 lakh. Its carrying value was 6,30,000. So 6 lakh 30 and the profit will be stated within the P&L. So to profit within P&L account, that will be 2,70,000 as we calculated. Correct? This will be stated in my P&L. This will be removed from my statement of financial position. Okay. Now guys, this is a revalued asset which has been sold. Right? Now this asset is sold. Correct? Now I do not have this asset. But for the same asset, I have revaluation surplus which is accumulated. Correct? I have a revaluation surplus which is stored in other comprehensive income. Right? Now this asset is sold. So technically it is irrelevant to keep the revaluation surplus. Right? So since it is irrelevant, I should remove this revaluation surplus. So I will also pass one more journal entry for the sale of an asset which has previously been revalued. So this asset is now sold and it was previously revalued. So whatever was the revaluation surplus stored in other comprehensive income, that shall now be transferred to the retained earnings as well. Right? So the journal entry that I will pass is revaluation surplus account debit to retained earnings. Right? This is also my income. Now that income can be claimed. Correct? This is also my gain. So it can be claimed now. So it will be stated within the retained earnings. That is going to be 1,35,000, 1,35,000. Now I sold the asset, so I have transferred it to my retained earnings, this revaluation surplus. So there will be nothing in OCI related to the asset that I now sold. Okay. So I hope this concept is clear to you all. Okay. Now we'll do a special sum. So you all have understood that, an asset which is previously revalued upwards, there is a revaluation surplus stored, after which if in case there is a revaluation loss, that part we have not understood, right? For a depreciating asset. Correct. I told you that, that much revaluation surplus will first be eliminated from OCI and then any amount above that, this one, any amount above that will be stated in our P&L. Correct. Because the same asset cannot have both the things. But here we did not look at depreciation. So where an asset is also being depreciated, what would be the accounting that we are supposed to understand. But before doing that, again, we'll take a 5-minute breather break. After that, we'll continue with the latter part. Okay, guys, I hope everyone is back from the short break. Let us continue with the latter part. And that is through a sum, you will understand that special case scenario wherein the asset is being depreciated, and with that, we are also supposed to sort out the revaluation. Correct? An entity revalued its land and buildings at the start of the year to $60 million. Okay, out of which $15 million belong to the land. That means to the building, the remainder is $45 million, and that is at the start of the year. Okay, the property, that is your land and building, had a cost of $30 million, from which $6 million belong to the land, and that means the remainder $24 million belong to the building 10 years prior to the revaluation. The total expected useful life is 40 years, which remains unchanged. Okay, unchanged. The entity's policy is to make an annual transfer of the realized amounts to the retained earnings. You can show the effects of the above in the financial statements for the year. Okay, so let us get started with the calculations. Now, firstly, guys, we'll take the original value, whatever it was for the land and building. I'll calculate it for land, for building, and the total. Okay, 10 years prior, the original cost for the land, as you can see in the question, for the land, it is $6 million and the total is $30 million. That means $6 million for the land. I'll take it as 6,000. For the building, it is 24 and the total will thus be 30. Correct? This is the cost which is 10 years prior. So I will charge depreciation of 10 years. Correct? Depreciation of 10 years divided by total useful life of 40 years. Correct? And the depreciation will only be charged to the building. Lands are never depreciated, guys. Always remember that, because lands have an indefinite useful life. Lands can be used forever, right? Land cannot be depreciated. Only the buildings are to be depreciated. So building will be 24,000 divided by 40-year useful life into 10 years of depreciation, or you can just take into 10 divided by 40. So the depreciation will thus be 6,000. Correct? My depreciation is 6,000. So I will identify the carrying value on today's date. Right? That is why I'm charging depreciation. So 6,000 will be land. It will be same. There is no depreciation. 18,000 will be the carrying value of the building and the total will be 24,000. Right? Now, on today's date, this was 10 years prior. Okay. On today's date, that is the carrying value on 1st Jan at the start of the year. Maybe I'll take it as 1st Jan, the start of the year. On 1st Jan, the carrying value is this much. But on this date, 1st Jan, my asset got revalued, and thus the revalued amount is nothing but, you can see at the start of the year it got revalued to $60 million, out of which 15 million belong to the land, right? So my land has been revalued to 15 million, or you can say 15,000. The total is 60,000, right? And the remainder is the revaluation of the building, right? That is 45,000. Correct? So the revalued amounts are these. What is the revaluation gain? Revaluation surplus, I would say. It is nothing but the carrying value was 6,000. It got increased to 15,000. So 15 minus 6, that is 9,000. Here also the carrying value is 18 and the asset got revalued to 45. So the building has a revaluation gain of 27 and the total gain will thus be 60 minus 24, which is 36,000. So the total revaluation surplus is 36,000, right? Now the asset was actually revalued at the start of the year, and you can see here the entity has a policy to make an annual transfer that you'll understand later. Now the total expected useful life was 40 years, which remains unchanged. Correct? That means the useful life is still 40 years. out of which 10 years have already been depreciated for. So the remaining useful life is 30 years, correct? So now I'll charge depreciation on the building only, okay? On the building, I will charge 1 year of depreciation divided by 30 years of useful life, which is the remaining useful life, because the useful life remains unchanged. So 45,000 into 1 divided by 30 years of useful life. My depreciation for this year after the revalued amount of the asset is 1500, right? So what is the carrying value of my property at the year end? The carrying value of my property at the year end is nothing but 15,000 for the land, 45,000 minus 1500, 43,000 for the building, and for the total, that is land plus building, it is 58,500. Correct? So we have calculated for the year end what will be the carrying value of my property, which will be stated in the statement of financial position. Okay. Now there is just one concept here that you're supposed to understand. That is, it is the entity's policy to make an annual transfer to the retained earnings of the realized amounts. Right? Now what happens is, before my asset got revalued, there is a depreciation, the old depreciation, I'd rather say. Right? Before my asset got revalued, there is an old depreciation which is charged. Correct? That was how much? 24,000 was the value of the building. Divide by 40 years of useful life. Correct? That means the depreciation that was originally charged is 24,000 divided by 40 years of useful life. That is 600. Correct? 600 was the depreciation charged. I charged it for 10 years. That is why I have written 6,000 here. Okay. But after the revaluation, the new depreciation is how much? After the revaluation, you can see the depreciation for 1 year that is going to be charged is 1500. Correct? The new depreciation is thus 1500. So that means initially I was charging only depreciation of 600, but after the revaluation, my depreciation increased and it became 1500. And why did it increase? Because I revalued my asset, correct? I revalued my asset from 24,000 to 60,000, correct? So technically, I revalued my asset and is the reason why my depreciation amount increased. So there is certain excess depreciation. Right? And what is the excess depreciation? It was charged 600 and now it is being charged 1500. So 1500 minus 600, 900 is my excess depreciation. This excess depreciation is solely because I revalued my asset and my asset value got increased after the revaluation. Correct? So where is my revaluation surplus stored? This 36,000 revaluation surplus is stored nothing but asset account debit, my property account debit to revaluation surplus account, right? That is 900, sorry, 36,000 and 36,000. That is my revaluation surplus, correct? Now, this is my revaluation surplus, guys, and this is stored in OCI. Right? I am charging excess depreciation solely because my asset got revalued and the revaluation surplus is stored in OCI. So that means excess depreciation I shall deduct from my revaluation surplus, correct? Right? It's not like the whole thing will be stated. When I prepare the statement of profit or loss, I will charge the depreciation, correct? My depreciation that will be charged is the new depreciation, which is 1500. But from this, it should have been 600, correct? It should have been 600, but I am charging 900 extra, right? That is why I became 1500, correct? So, technically I am charging extra and stating it within my P&L because, my asset got revalued. But this 900 should have been here, no? Because it is solely because of the revaluation surplus. So, when I state my other comprehensive income, in that I will state revaluation surplus to be 36,000 and from that I will deduct the excess depreciation From that, I will deduct the excess depreciation. So my revaluation surplus will thus go down to 35,100, and this excess depreciation, I will give it back to the retained earnings, correct? Technically, my profit is reduced by 1500, correct? So, it should have been reduced in the name of depreciation, it should have been reduced only by 600, but I have reduced by 1500. So, I will technically take it back, right? I will take it back. So, the journal entry that I will pass, I will remove that 900 from my revaluation surplus. So revaluation surplus will be deducted by that amount, and I will take it back to my retained earnings. I will add it to my retained earnings, that 900. Right? I will add it back because I charged higher depreciation solely because of my revaluation surplus. Correct? So this will be stated back. This is the calculation that you're supposed to do only when it is the entity's policy to actually make a transfer of the realized amounts to the retained earnings. They will mention in the question that it is the entity's policy to do so. Then and only then you'll make this adjustment. Otherwise, you're not required to make any adjustments for this transfer. Okay. So let us prepare the statement of profit or loss now. The statement of profit or loss will be prepared. Depreciation will be stated. That is, as I already told you, 1500 is my depreciation which is to be stated. Correct? Then I will state, I think depreciation is the only thing, right? In the statement of profit or loss. Below that, I'll prepare my other comprehensive income where I'll state my revaluation surplus. That is 36,000, right? That is 36,000. But since it is the entity policy to make an annual transfer, I will remove the excess depreciation from this and state only 35,100. Okay. Then when I prepare the statement of financial position, my property, that is my complete land and building, will be stated at 58,500 at the year end, which we've already calculated. In the equity section, I will state my revaluation surplus to be 35,100 and to my retained earnings. Now, retained earnings in this question is not mentioned. Maybe say the retained earnings are the total accumulated profits to date. Okay. If my retained earnings are 5,000, obviously I remove the 900 from it and I will add it to my retained earnings, that 900. So my retained earnings will thus become 5,900. Just keep in mind, guys, this 5,000 I've just taken an assumption because they've not mentioned in the question. Okay. So I hope this part is clear to you all. If there are any doubts, you can directly ask me in the comment section. Okay. Now IS 20 is an accounting standard that we'll do later. Firstly, we are going to jump to the next accounting standard, which is a very short accounting standard, that is IS 23 borrowing costs. So let us get started. With this, guys, our IS 16 has come to an end. We have understood various concepts wherein there is a revaluation surplus, there is a revaluation loss, the two models, that is the cost model and revaluation model, the initial measurement, what is to be capitalized, what is not to be capitalized, and also eventually we understood that if an asset is disposed of, we can make a transfer from the retained earnings, from the revaluation surplus to the retained earnings for the previously revalued asset. And lastly, we also understood the calculation of excess depreciation if it is an entity's policy to do so. Okay. Now we are going to jump to IS 23 borrowing costs. So, what does IS 23 prescribe? International Accounting Standards 23 borrowing cost is nothing but where in case, for instance, I'm actually constructing an asset. Okay, maybe I'm constructing a machinery. For the construction of that machinery, I might need to hire certain laborers. I might need to purchase certain material. I might need to incur certain professional fees for hiring professionals so that they can help me out with the construction of that machinery. For the construction of that machinery, I'm going to incur these costs, right? I do not have cash, so maybe I'm going to take a loan, right? So for the construction of this machinery, guys, if I'm taking a loan, so those loans, I'm going to pay interest on them, correct? So interests are going to be my expenses. I have taken a loan for the construction of that machinery, and on that loan I'm paying annually certain interest. So that interest is going to be my expense. Now that interest is known as the borrowing cost. I have borrowed certain money for which I'm paying that cost, that interest. So those are known as borrowing costs. Borrowing costs are going to be capitalized to the value of that machinery solely because I have taken that loan not for any other purpose but for the construction of my machinery. So guys, because I've taken that loan for the construction of that machinery, the expenses of the interest payment that I'm making, those are going to be recoverable from the machinery, because once I construct the machinery, I will generate future economic benefits, correct? So interest expenses that I'm incurring for the loan that I've taken, those can be capitalized to the value of the asset under the name borrowing cost, because as per the IS 23, that loan is solely taken for the purpose of construction of an asset. So it will be recoverable from the future economic benefits that I generate from the use of that asset. So it can be capitalized to the value of that asset. Okay. So let us understand IS 23 borrowing costs. IS 23 borrowing cost prescribes the criteria for determining whether the borrowing cost can be capitalized as a part of cost of acquiring, constructing, or producing a qualifying asset. Okay. So as I told you, always remember borrowing cost can only be capitalized. Say that I've taken a loan for the construction of a machinery. Okay, I've taken a loan for the construction of a machinery. I am paying interest on that loan, right? But this interest, which is an expense to me, that can be capitalized to the machinery because I'm paying all this solely for the purpose of construction of that machinery. And once that machinery is constructed, I can either sell it off and generate economic benefits or use it and generate economic benefits. So these expenses are going to be capitalized to the value of that machinery under the name borrowing costs. Okay, under the name borrowing costs, and is the reason why as per IS 23 we will do this accounting. Okay, technically it is to be expensed, but if in case it is taken solely for the purpose of construction of something, then it can be capitalized to that asset. Okay, always remember you can only capitalize when you're actually taking a loan for construction. If you're just purchasing an asset and for that it is considered, then no. Okay, it should be mainly for the construction of an asset. Okay, technically it should be for a qualifying asset. Now what is a qualifying asset? Qualifying asset is any asset which takes a substantial period of time to uh, be brought into use or for its intended sale. Right? So any asset which takes a substantial period of time to be prepared for its intended use or for the sale of it can be known as a qualifying asset. I am constructing a building, it takes a substantial period of time to construct it, and thus only for that construction of the building, if I am taking a loan, the interest that I am paying on that loan can be capitalized as borrowing cost. Okay. Now guys, under this criteria, the word substantial period means what? So substantial is a word which is not defined anywhere under IS 23, but you can say substantial period means something which takes more than 1 year to be prepared. Okay. So any asset which takes more than 1 year to be constructed, that can be capitalized. The interest expense that I'm incurring on that asset can be capitalized on to the value of that asset. Okay. Okay. So borrowing costs are nothing but the interest expense that I'm paying, the interest that I'm paying, and also any other costs which are related to the borrowing of funds. And qualifying asset, which necessarily takes a substantial period of time, that means technically more than 1 year, to get ready for its intended use or for its sale. Let us do an example of borrowing cost. Okay. Maybe say I've taken a loan of 10 million, or I'll just take it as simple. I've taken a loan of 10,000. Ignore this, guys. As of now, ignore it. I've taken a loan of 10 lakh. Okay, I'll take 10 lakh. I've taken a loan of 10 lakh and on that I'm paying 6% interest. Right? I've taken this loan for the construction of a building. I've taken this loan for the construction of a building. So what is the interest that I'm paying on this loan? It will be 10 lakh into 6%. That is nothing but 60,000. Correct? 60,000 is the interest expense. This should have been treated as an expense within the P&L, but since this loan I've taken for the construction of the building, this 60,000 will not go to P&L. It will rather be capitalized to the value of the building as borrowing cost. So it will be added to the value of the building, 60,000 thirds. Okay. So I hope this part is clear to everyone. Now we will do this sum. Now there is a possibility that you might also take a pool of funds, right? That means you just have not taken one loan, but maybe you've taken more than one loan. Okay. Maybe say I've taken one loan which is of 10 lakh. Okay, I'll take this example only into consideration. If an entity had a 10 million 6% loan and a 2 million 8% loan, I have taken two separate loans. On one loan, it is 10 million. So it will be, technically I'll take it as 10,000. Okay. 10 million, I'm taking it as 10,000. Into 6% loan. Right. This is the loan. So the interest on that loan is 10,000 into 6%, which is 600 is the interest for the first loan. I've also taken a second loan, which is of 2 million. So 2,000 into 6, for the second loan, 8% is the interest, correct? So I'll state here 8%. That will be 2,000 into 8%, which is 160. So the total interest that I'm paying is 600 plus 160, that is 760. And the total loan amount that I have is 10,000 loan plus 2,000 loan, that is 12,000 is the total loan. 12,000 is the total loan that I've taken, 760 is the total interest that I'm paying, right? So 760, which is the interest that I'm paying, divide by 12,000, which is the total loan, into 100%. So I will get it in percentage. That what is the percentage? 760 divided by 12,000 into 100. So I will get 6.33%. Right? 6.33%. So this is the interest that I'm paying. Whenever I'm taking two separate loans, I will always calculate the weighted average cost of borrowing. That means the total of those two interests divided by the total amount of loan. Okay. So 6.33% is the total interest. Maybe I've used maybe say 5 million from this loan. Okay. The total loan that I took was 12 million, but I used only 5 million. So it will be 5 million into whatever is the amount spent. Okay. So I've spent 5 million to date. I took a total loan of 12 million, but I spent 5 million till the today's date. So 5 million into 6.33% that I've calculated, that will be 5,000, or you can say 5 million into 6.33%. That is, I will pay 316.5 as my interest, and that will be capitalized to the value of the asset. Okay. So I hope this part is clear to you all. Okay. Now let us understand that from what period you are supposed to capitalize to the value of the asset and till what period you're going to capitalize to the value of the asset. It's not like, that I've taken a loan on 1st January. I have not started preparing my asset. I started preparing my asset on 1st October. I am saying that I've taken a loan from 1st January. I have taken it for the asset. So I'm going to capitalize it for the asset for every month. I will say no. Why did you take a loan on 1st Jan? Right? Your asset, you're going to intend to start preparing your asset from 1st October. You're starting the construction from 1st October. Why did you already take a loan on 1st Jan? Right? It should have not been taken. It is not related to the construction period. Correct? So whatever interest I'm paying from 1st January to 31st, 30th September, or you can say 1st October, that interest cannot be capitalized because that is not related to the asset. Correct? That is a normal loan taken. So whatever is the interest on it, I will expense it. I will not capitalize it to the value of my asset because my asset construction is only not started from 1st Jan, right? So there should be a certain date from which it is fixed that you can commence the capitalization and also cease the capitalization. So for that there are certain conditions, right? So all these following conditions shall be met. If all these are met, you can start the capitalization of the interest expenses that you're incurring. Okay. Firstly, the conditions are expenditure for the asset is being incurred. For the asset, I'm purchasing the materials, I'm purchasing the all types of cements and everything that I need. Okay, I'm hiring the laborers and everything. So those are all the expenditures that I'm incurring for the asset. Okay, so I've taken a loan, I'm making use of it, right? I'm incurring those expenses. So that would say that, okay, my activities are actually going on, right? My activities are actually going on. Then borrowing costs are being incurred. That means technically I'm paying the interest on it, right? And thirdly, activities that are necessary to prepare the assets for its intended use or sale are in progress. Okay. That means it's not like, I've just purchased all the materials and everything. I'm doing the activities to prepare my asset. I'm doing the activities to construct my asset. If all these three conditions are met, then and only then I can capitalize the interest expense from that date to the value of that asset. Okay. So I hope it is clear. Now, cessation of capitalization. When do I cease the capitalization period? Capitalization of borrowing costs should cease either substantially all the activities necessary to prepare the qualifying assets for its intended use or sale is complete, or the construction is suspended. Now, what they are trying to say here, maybe say my construction period began on 1st October and it got completed on 31st December. Okay, it was just a 3-month construction. Technically, I should not take solo. I should take something as a qualifying asset, right? So maybe say my construction period began on 1st April, right? And it ended on 31st November. So my construction period was from 1st April to 30th. I'm so sorry. From till 30th November, right? I took a loan on 1st Jan and it was taken till 31st December, right? I took a loan on 1st Jan and it was taken till 31st December. My asset got completed. My assets construction got completed on 30th November. I brought the asset into use on 1st Jan next year. Or maybe I'll just say uh, 31st December I'll keep. Okay. My assets construction is completed on 30th November. But by the next month end, I brought my asset into use. So will I capitalize the interest expense till 31st December or 30th November? Obviously, it is going to be 30th November. It doesn't matter when I bring the asset into use. My asset is prepared for its intended use or sale. From that period, I will cease my capitalization. Correct? From that period, I will cease my capitalization. So that means if in case my asset is already prepared for its intended use or sale on 30th November, then I can capitalize only till 30th November, irrespective of the fact whether I've brought it after 3 years or 4 years or 3 months or 2 months, right? Into use. So technically, only the period from 1st April to 30th November will be capitalized. For the period from Jan to 31st March will not be capitalized, and from the period of, for the month of December it will not be capitalized. Okay. So I have completed all the activities. I have prepared the asset completely from that date. it will be ceased to capitalize, even though I'm, bringing the asset after 2 months or something into use. And lastly, if in case the construction is suspended for a period of time, maybe my employees are not working well, we had an industrial dispute, and they have stopped to work for a period of 2 months. So during those 2 months, it is an expense to me because it is a wastage, right? The interest that I'm paying on the loan, that interest obviously I have to pay, correct? But the work is not there, work is not done. So it is an expense to me. It is like a wastage to me. So wastage are already expense to the P&L. They are not to be capitalized within the asset value, correct? So I hope it is clear to you all. Now we'll just take a 5-minute breather break again. This concept is clear. We'll just solve one more sum. This was a very short accounting standard, guys. After this, we are going to cover the latter part. Just one sum we'll solve, and after this, we are going to cover the next accounting standard. Before that, we will just take not a 5-minute, we'll take a 10-minute break now. Okay. So it is 12:06 right now. We meet by 12:60. Okay, guys, I hope we are back. Let us get started with the first sum. I mean, technically, the first and the last sum that we're doing for IS 23, that is borrowing costs. Wilson received $18 million 5% loan on 1st January 2018 to finance construction of a new factory. That means he took a loan of $18 million on which 5% is the interest which is payable, and he took it on 1st January 2018 for the construction of a factory. As the funds were not all required immediately, Wilson invested $6 million in 2% bonds until 31st May 2018. So as soon as he took the loan of $18 million, he did not require all the amount of the loan. So he took 6 million from that loan and invested it in 2% bonds. So on that he will receive interest income because he has invested, right? So 2% is the interest income that he will receive, but that is up till 31st May 2018. That means he invested only for 5 months: January, February, March, April, and May. Construction of the factory began on 1st March 2018 and was completed on 31st December 2018. You have to calculate the amount of interest to be capitalized in respect of the factory as at 31st December 2018. So let us get started how we are supposed to solve this sum. Right? Firstly, just remember the dates, just keep them in mind that the construction has begun on 1st March 2018 and it ended on 31st December. So all of the interest, income and expense we are just going to capitalize during this period. Firstly, guys, what is the interest payable that we are supposed to capitalize, correct? Interest payable for the full year, 18 million into 5% loan I've taken. Into 5% loan, but this is for the full year, correct? From 1st Jan to 31st December. I don't need it for the full year, correct? Because I need it only from 1st March to be capitalized. My construction period began on 1st March, correct? So I can capitalize only from 1st March. So for the month of January and February, I will not capitalize, correct? Only from 1st March to 31st December, I will capitalize. So I will capitalize only into 10 months divided by the 12-month period. So the interest payable which is going to be capitalized is 18,000 into 10 divided by 12. Right? Which is, sorry, I did not do 5%, into 5% into 10 divided by 12. This is the interest expense which is to be capitalized, which is 750. Correct? For the first 2 months, that is for January and February, the interest expense that I've paid, that is 18,000 into 5% into the first 2 months, that is 2 divided by 12, which is nothing but 150. This will not be capitalized. This will directly be expensed as an interest expense within the P&L. Okay, as an interest expense within the P&L. Now guys, we have to calculate the amount which is to be added to the value of the asset as a borrowing cost, that means capitalized. So that is 750. But also there is one more thing here, that is he actually is earning interest by investing somewhere, right? So there is certain interest receivable also on it, correct? The interest receivable, he invested as soon as he took the loan. He invested 6 million, correct? In 2% bonds. So 6,000 in 2% bonds. This is the interest income that he is generating, correct? And he has generated only for 5 months, right? So 5 divided by 12. Because obviously he is invested only for 5 months. He invested on 1st January and took it back on 31st May. So 2% is for the full year, but he has invested only for 5 months. So it will be 5 divided by 12. That is going to be into 2% into 5 divided by 12. That is going to be 50. Correct? 50 is going to be the value here. But this interest income relates to which months? He invested on in Jan, so it relates to the month of Jan, February, March, April, and May. Correct. For the month of January and February, my construction period did not begin. Correct. For the month of Jan and Feb, my construction period did not begin. It began from 1st March. Right. From 1st March. So only for these 3 months I can capitalize this interest income. Correct. For the month of March, April and May, I cannot capitalize for Jan and Feb. Right. So from this 50 also, I will capitalize only 3 divided by 5. Right. 5 months is that. So 50 into 3 divided by 5, that is going to be 30. Only 30 can be capitalized and only, 30 will be deducted here. Okay. Only 30 will be deducted here in the interest income. Why is it deducted? We are calculating the borrowing cost, guys. If this is the cost and we have generated certain income from the cost, we are supposed to exclude this. We are supposed to deduct this, and 720 is our borrowing cost. Right? This is our borrowing cost, and this will be capitalized. This will be capitalized within the value of the asset. What happens to the remaining 20, that is for the month of Jan and Feb? I also earned interest 50 into 2 divided by 5. Correct. 3 divided by 5 is already dealt with here, which is deducted because it is related to the period. So it is deducted from the interest expense. But for the first 2 months, that is for Jan and Feb, it is 50 into 2 by 5, which is 20. So this 20 will be normally treated as an interest income and stated within the P&L. Okay. So the interest income first 2 months will be stated within the P&L. For the last 3 months, it is related to the construction period. So it will be deducted from the borrowing cost, and the remainder of the borrowing cost will be capitalized as to the value of the asset. Okay. So I hope this part is clear, guys. Now we'll do the last accounting standard for today. That is going to be, where is it? IAS 20. Okay. This is the last accounting standard that we are covering for the day. The last accounting standard, the remainder 2 accounting standards will be dealt with in the next class. Okay. So let us head on with IAS 20. Now, what is International Accounting Standards 20? It is actually, firstly, the name of it is government grants. Okay. The name of this accounting standard is nothing but government grants. Now, there are some sort of government grants which are provided by the government. Maybe say, I'm purchasing a factory wherein, I'm purchasing certain machineries which are environmental friendly. So they are not harming the environment at all. I'm not contaminating the environment by making use of those machineries. So the government will say that, okay, I would encourage or I would appreciate such a purchase that you've made, that you're actually doing your business, but also you are concerned about the environment. So I would give you a grant on it. So the government would say that, if you are purchasing a machinery of 1 lakh, since it is an environmental friendly machinery that you purchased, I'll contribute 20% of this machinery. Okay, the government will pay 20% of this machinery. That means 20,000 will be paid by the government, and for the purchase of this machinery, I will have to pay only 80,000. Correct? So those are certain government grants which are provided to me. Okay. Now, when are these government grants provided? Okay. Before that, ignore when are these government grants provided. Firstly, there are 2 types. One is a government grant which is provided in an economic form, right? Like the monetary form, that they will pay 20%, right? So that is a monetary cash form which the government has provided me the grant, right? And the other one is government assistance, right? So for the monetary benefit that the government has provided me, for that I'll do the accounting. But there is also any sort of government assistance which government might provide, like, any sort of technical advice. or marketing advice. Right? The government has said that, this is the advice, take the advice, from this your sales will be increased. The government has given me an advice because of which my sales increase. But I cannot measure a value of this advice. Correct. I cannot do a monetary measurement of this value of advice. And is the reason why I do not have a reliable estimate or, a specific value for it. Correct. So since I do not have a specific value for the assistance provided to me, that is not going to be capitalized within, that is not going to be accounted for within the financial statements. For that, I will just need a disclosure to my notes that the government has provided me this advice. Okay. I will just make a disclosure for the government assistance. There is no accounting for government assistance, and for the government grant which is provided to me in monetary terms, for that I will actually do the accounting. Okay. So I hope you all are clear with which government grant and which government assistance is to be treated how. Okay. Now, IS 20 are nothing but assistances by the government in the form of transfer of economic resources. Assistances in the form of economic resources means nothing but government grants, right? Which is in return for past or future compliance with certain conditions relating to operating activities of the company, right? So they are saying it could be in the past or because of the future compliance with the conditions of the government, right? The government will say, I will provide you a grant of 20% if you purchase an asset which is environmental friendly. So I purchase the machinery which is environmental friendly. After purchasing the machinery, I have complied the condition of the grant and then the grant is received. Correct? Then the grant is received. Right? So this is for the past compliance that I have complied. I have already purchased the machinery, then I'll receive the grant on the same. Right? That is for the past compliance. And the second one would be for the future compliance. Maybe say that, I told the government that I will hire 50 employees into my business every year for a period of 3 years. Okay. I will hire 50 employees every year into my business for a period of 3 years from certain rural areas so that they get employment opportunities. Okay. From certain rural areas, I will hire employees so that they get employment opportunities, and I will hire 50 employees every year. So the government said, okay, you're doing this. It is a good cause. So the government said, for every year, I will pay you 500,000. Right. So the government technically paid me 500,000 into 3 years. That is, the government paid me 15 lakh in total already in the first year. Right. The government already paid me 15 lakh for all 3 years. But my future compliance is still left, right? I have to hire 50 employees every year for a period of 3 years, correct? The government has already paid me. So the government has already paid me the amount, but I have to comply with the government's conditions. That means I have to hire 50 employees from the rural areas every year. So that could be for the future compliance. Okay. Now, government grants related to assets are government grants whose primary conditions, okay, and government grants related to income are government grants other than those related to assets. So what they are trying to say here, guys, is that if it is a grant related to asset, maybe I purchased a machinery and on that I'm getting a grant. So that is known as capital grant. So there are two types of grants. The first one is known as a capital grant, which is a grant related to asset. For the purchase or for acquiring an asset, I am getting a government grant, so it is known as a capital grant. And the other one, maybe I'm incurring certain expenses. Like, I'm incurring expenses for Swachh Bharat, like, cleaning up the whole country. So maybe I'm cleaning up the beaches, I'm cleaning up the roads, I'm cleaning up the bridges, right? So I'm contributing to the environment through those purposes, right? So that I'm not purchasing an asset there. I'm just incurring expenses. So for those expenses, maybe the government is providing me with a grant, right? So those are grant related to expenses, or you can say grant related to income straightway. Okay. So there are some grants which are known as capital grants for the purchase of asset, and anything which is not a capital grant will be known as revenue grant, right? That is grant related to the expenses that I'm incurring. Okay. Like our employees example that I gave you, that I'll hire 50 employees every year, that I'm not purchasing an asset, right? Employees are not my asset. But the salary that I'm paying to each of those 50 employees, that is an expense to me, correct? So those expenses, those are known as my revenue grants, correct? So there are some expenses which are for which I receive a grant. Those are known as capital grants, maybe for the purchase of asset or maybe for hiring employees. Those are just expenses that I'm incurring, not for the purchase of an asset. Then those will be known as revenue grant. Okay. So what will be the accounting treatment of capital grant and revenue grant? Revenue grant is quite simple. So firstly, we'll understand revenue grant, then we'll jump to capital grant. Okay. Now guys, what is revenue grant? Revenue grant, like for example, contribution towards payroll costs, right? Maybe say I am actually doing a very good business. Okay. Like, I am running a ecotel, which is a environmental hotel, right? Environmental hotel, where everything which is environmental friendly is used, like the towels and everything. They are actually, reused again and again. They are not thrown away and everything. So technically, I am running an ecotel, which is an environmental hotel. So environmental friendly hotel. So maybe I would incur certain expenses there, right? So the government will provide me a grant for the same. So whatever grant the government has provided me, maybe say the total expenses that I'm incurring is $10,000. The government has provided me the grant for those $10,000. Right. So there are two treatments which are allowable. One is it can be presented as a credit on the P&L, or it can be deducted from the related expenses. My expenses are $10,000. Government has provided me that $10,000, so that will be deducted from here and my expense will become zero. Okay. So that is deducted from the related expenses directly. Okay. But some countries may say that, this is not allowable because you're not showing all the expenses clearly within the financial statements. So what can I do is, then I can state $10,000 of expenses separately, right? I can show $10,000 of expenses separately, and I'll show a grant also separately. Okay, that I got a government grant of $10,000. So it will be stated in the income as in the P&L as an income, and this will be shown as an expense, right? So this will be shown as an income in P&L, and this will be shown separately as an expense. So you can show them separately, or you can just directly deduct it. Both of the treatments are allowable. So you can directly do whichever treatment you want to choose to have. Okay. Now we'll do a sum on this. But before that, we'll just take a 5-minute break. Okay. And after that, we'll return with the last part, that is our government grant. Okay, guys, I hope we are back from the short break. So, till now, we've understood that there are two types of grants. One grant is related to the revenue, and the other grant is related to the purchase of an asset, which is known as a capital grant. Now, this is an example of the revenue grant. So, just focus on an entity is given $3 lakh on 1st January 2011 to keep staff employed within a deprived area. Okay, so to keep staff employed within an area, they have been given $3 lakh. The entity must not make redundancies for the next 3 years. That means this is paid 1 lakh each year for the next 3 years. Or the grant will need to be repaid. That means if in case they remove any of the employees, then they will have to repay the complete grant. They cannot do so, right? By the first year end, that is by 31st December 2011, no redundancies have been taken place and none are planned. So that means technically we can recognize it for the first year and also for the future years. How we'll do it, that I'll show you. So the grant should be released over the next 3 years, meaning that $1 lakh is taken to P&L each year. Okay. So let us do an exam. Let us see how they have solved it. Technically, the government grant that has already been received is $3 lakh, correct? The government grant that has already been received is $3 lakh, right? Now, this grant I have received $3 lakh for actually complying with the government for a period of 3 years, right? This I received it on 1st Jan 2011. 1 year has passed. By 31st December, I have complied with the conditions of the government and none of the grant is going to be repaid because obviously I am complying with the conditions of the government and none of the employees left the company. Okay. Now, when I received the grant initially, it is my liability, correct? Because I have not complied with the condition yet. So on 1st Jan, what is the journal entry that I will pass? The journal entry that I will pass is nothing but I have received cash from government. So cash account will be debit. 2, I will treat it as a deferred income. Deferred income is nothing but on a future date, I've received the money right now, but I'm creating a liability. On the future date, I can actually recognize it as an income. As I keep on complying with the conditions of the government every year, I can actually amortize this deferred income. How we'll do that, you'll understand. So technically right now you're creating it as a liability that is deferred income, which is $3 lakh. Okay. By the first year end, I've complied with the conditions of the government. So that means I have a deferred income balance of 3 lakh, which will be taken to P&L every year as an income. So now it will be taken as deferred income will be debited. It is a liability. It is reduced. My liability will be reduced by 1 year amount and it will be stated as a government grant to P&L. Credit. Okay, government grant credit account. It will be taken 3 lakh is to be distributed over the period of 3 years. So it will be 3 lakh divided by 3 year period. 1 lakh I can take every year to my P&L, right? So this 1 lakh I will take every year to my P&L. So technically 1 lakh will be taken to P&L in the first year and under the name government grant credit. In the second year, one more 1 lakh will be taken. In the third year, if I comply with the condition, the last 1 lakh will also be taken. Okay. So this way, I'm going to credit it every year to my P&L and initially I'll create a liability. That liability will be reduced every year by 1 lakh. Eventually, the liability will become zero and all 3 lakh of income can be credited to my P&L because obviously we run on an accrual basis. So as we comply with the conditions, then we can recognize directly as an income within the financial statements. We cannot take the total income of 3 lakh and state it within the P&L directly. Okay. So this is the solution. I think it is fairly clear to everyone. Let us jump to the last part of our government grants, that is capital grants. Now there are two treatments that you can do for your capital grants. One is write off the grant against the cost of non-current asset And second one, treat the grant as a deferred credit. Okay. What do you mean by that? Maybe say, okay, we'll directly do it through an example. So I think it will be fairly clear. Okay. An entity opens a new factory and receives a government grant for the factory of $15,000 in respect of the capital equipment costing $1 lakh. So they purchased a capital equipment of $1 lakh and for which they are going to receive a government grant of $15,000. It depreciates all its machinery on 20% straight line basis. You have to show the effect in the statement of profit or loss using both the methods of government grant. Okay. So there are two methods of actually treating a capital grant, that is deducting from the asset and treating it as a deferred income. Right? These are the two methods. Deferred income method, same as I previously explained you. Deducting it from the asset is nothing but I purchased the asset at $1 lakh and for that I received the government grant of 15,000. So that will be directly deducted from the value of my asset and I can take the value of my asset to be 85,000. So under this method, my depreciation will be 85,000 is the value of my asset, divide by, it is actually depreciated on 20% per annum basis, correct? It is actually 20% per annum basis. So 20% per annum will be the depreciation on it and that will be into 20 divided by 100. This is my depreciation. So when I prepare the statement of profit or loss, I will state depreciation to be 17,000 as we calculated. And in the statement of financial position, I will state my asset to be not 85,000. 1 year has passed maybe, right? Assets original value was 85,000, correct? 1 lakh minus 15,000. I directly deducted the complete grant from the asset value. Okay, minus 17,000 depreciation for the year. So the carrying value at the first year end will be 85,000 minus 17,000. That will give me 68,000, right? So I prepared the statement of profit or loss and the statement of financial position for the first year end under the method deducting from the asset. Right? Now we'll understand the second method, that is deferred income. Technically, deferred income, whatever cash I've received from the government right now, will be cash account debit to liability just like we did it earlier. That is deferred income account, which is nothing but how much have I received? 15,000, correct? So 15,000 is the amount that I've received and that will be treated as a deferred income. But the only thing is that here, how will I distribute it? How will I allocate it every year to my P&L as an income? That we are supposed to understand. So asset has a value of 1 lakh. This is not the deduction method. So I will not deduct the government grant from it. I will just simply calculate the depreciation on it. The depreciation is 20%. So it will be 1 lakh. Always remember here, I will not take 85,000. Okay. Into 20%. My depreciation will be 20,000 and the carrying value of my asset at the first year end will thus be 80,000, right? This is the carrying value of my asset at the first year end. Now guys, this is the carrying value of my asset at the first year end and I've done no adjustment till date for the government grant, right? 1 year has passed, right? So like I depreciate my asset, I will also depreciate the government grant. Okay, I will allocate the government grant. So my total government grant is 15,000. On that also, every year 20% I will charge and I will take it to my P&L as an income. So 15,000 into 20%. The same thing that is given for asset, that same thing will be applied for the government grant also. So that means technically 3,000 will be taken every year related to this asset because it is related to the purchase of an asset, right? So I think it should go hand in hand with the with the useful life of an asset, right? So 3,000, 3,000, 3,000 will be taken every year for a period of 5 years. So when I prepare the statement of profit or loss, I will state depreciation on the asset, which I've calculated to be 20,000, correct? And I will state government grant credit separately of 3,000 for the first year end, right? I've used the asset for 1 year. So technically I've made use of the government grant also for 1 year. Okay. And the journal entry for it will be simply understanding government grant in total was 15,000. 3,000 is allocated this year into the P&L. 3,000 is allocated into the P&L. So the remainder is 12,000 pending, right? The remainder is 12,000 pending, right? So the journal entry at the first year end for taking it to P&L will be deferred income will be debit, and 2 I will state it as a government grant credit in P&L, right? Or I can just say government grant rather. Okay. 3,000 will be taken to my P&L as an income, right? This is the journal entry that I will pass. And obviously I've debited, so it will reduce by 3,000 and my deferred income will thus be 12,000, correct? So this is how I will do the calculation, and my government grant credit I will state in my P&L to be 3,000. In the statement of financial position, I will state my asset, which was having a value of 1 lakh minus the depreciation charge to date of 20,000. So my assets carrying value at the first year end will be 80,000. And in the liabilities section, I will state deferred income, right? Firstly, I'll do the allocation, non-current liability and the current liability. In both, I will state deferred income. Why I'm doing this, I'll show you. So technically 3,000, I've taken it this year because 1 year has passed, correct? So I've used the asset for 1 year. I can use the government grant for 1 year as an income, right? So government grant income 3,000 I've taken to P&L. 12,000 is the balance of deferred income which is remaining, right? 3,000 again will be taken from this in the next year. So there is 3,000 which is going to be settled in the next year. So 3,000 of the deferred income will be stated in the current liability at the first year end, and the remaining 9,000 will be stated in the non-current liability. Because see, if I'm at the first year end, 3,000 I've already taken to P&L. By the second year end, I will take 3 more thousand to P&L, right? So technically, this 3,000 is settled within a period of 12 months from first year end to second year end, correct? So something which is going to be settled within a period of 12 months is considered as a current asset or a current liability. So 3,000 will be taken to P&L next year. So I'm putting it in the current liability, and obviously 3,000 is there in P&L, 3,000 in current liability. So 15,000 minus 3,000 minus 3,000, 9,000 will be stated in my non-current liability. Okay. So I hope this concept is clear to you all. With this, our government grants also come to an end, and I hope that you all have understood the basics of government grant. You all can actually solve more and more sums on this to get more clarity. There might also be a couple of sums in the section B questions that we are going to solve tomorrow. So be prepared for it. We are going to solve it tomorrow itself. Okay. So thank you so much for your time and efforts, guys. In the next class, we are going to cover the next two accounting standards that is remaining for today, that is IS 40 and IS 38, which will be completed quickly, after which we will solve a couple of section B questions. So thank you for your time and efforts. We meet in the next session at the same time, that is 9 a.m. to 1 p.m. Thank you everyone.